Welcome. My name is Roy Maddox, and I'm the host of the Charlotte Investors Business Daily Meetup group, along with my son, Wesley Maddox. We'll both be tag teaming tonight to provide you with hopefully some useful information to help you and us navigate through the current bear market. Let me give you a little bit of background information. We've been hosting the Meetup group here in Charlotte. We've got about 1,300 members. I've been the host for about 5 years, and we meet the second Tuesday of every month to share our ideas, concepts, strategies, in which we were able to input and exchange views with like-minded investors. Give you a little bit of background about me. I met William O'Neill, who is the founder of Investors Business Daily. I met him in 1988 along with his protege, David Ryan, and that really changed my life. Bill wrote a book, How to Make Money in Stocks, and he's famous for developing the CanSlim formula, which is a system of investing that has to do with earnings, companies making new highs, new products, new transitions, new management that typically lead you to the leading stocks in the marketplace. And that's what we're trying to identify are really the true market leaders. We have found, and we believe, many of us and our members as well believe that you can have life-changing results if you can identify and invest in a couple of these true market leaders. And these are leading stocks that have tremendous growth prospects that last typically about 93 weeks. And the time to identify those is in the beginning of a new bull market or at the end of a bear market, because they'll start showing themselves. And we're going to spend a lot of time tonight in the second part of the presentation and trying to identify, who these might be and what a proper setup might be. Wes will be taking us through the first part of the presentation, in which we cover our process, and then I'll take charge of the program after we take a break, and we'll talk about individual stocks for the second half of the program. So we'd like to welcome you. We have many experienced investors and traders that are on the on the presentation tonight, as well as some newbies. So we would like to welcome you. Certainly, if you're new, don't be shy, don't be intimidated. Many of us were novices at one time, but we have an attitude of sharing what we've learned over the past decades, and we hope that you can learn something from the process tonight that we go through. It's a very volatile time in the marketplace, but it's going to present tremendous opportunity when this bear market is over, and we'll share with you a lot of our technical views on the current market and really how we're positioning ourselves, which is quite defensive right now. We're 100% in cash, and we have been most of the year so far, except a few brief times where we've dipped our toes in only to be negated. So with that in mind, let me turn the program over to Wesley, and we'll take you through our prepared remarks. And we will have a slide deck from the presentation tonight that we'll send that to you. If you're not on our email list, in the chat box, enter your email information, and we'll put you on our email list so that you can get communication when we frequently consult and talk to the members of the group. So again, thank you for attending tonight. And Wes, with that, you can take over now.
All right. Thank you. All right, so the title of our presentation we're going to talk about today, naturally, big inflation report on Friday that kind of sparked a sell-off, and just the follow through of that on Monday, and not much of a bounce at this point yet. But that's kind of, a little bit about what we'll focus on. Yeah, like my dad said, we're all different experience levels, but it's always great to get together. Always look forward to this every month, just to share ideas, talk about some stocks that may not be on everybody's radar, but we're all looking for the same types of all looking for the same types of stocks. And here's this CAN-SLIM acronym that we were talking about, made famous by Bill O'Neill. I never met Bill O'Neill myself, but I was indoctrinated at a very early age that this was, the way to do things to really have life-changing investment results, and that has only grown within me for last decade or more. So first, I'll briefly go over what we kind of think about as our 3 pillars of our investment process. These 3 things that are basically our building blocks for what we want to, when all these things kind of combine, that's when we're going to be able to make the most money in the market. And just real quick, if someone could mute, it's K Zachary. I'm not sure, but if you can hear me, thank you. Oh, all right. So anyways, the first thing, technical analysis. That's that's really the most important thing. We're trend followers. We're looking at different measurements as measured by price, most importantly breadth. We'll talk a little bit about that and how we're approaching some pretty washed out levels as measured by a lot of these things, these lists here. Sentiment also, we know sentiment's been very poor, and it's been poor for a few months now, but we're not quite seeing price action of certain things that we want to see, capitulatory levels of, 2 of those being the VIX and the put call ratio. The put call did perk up a little bit, I know, but the VIX still, not really spiked at this point to signal real capitulation yet. And then again, just revisiting fundamental analysis, really thinking about this CAN-SLIM acronym, looking for good history of earnings growth, new products, if they're leading, if they're in the top industries, if they're the leader of that top industry, and market direction, of course, being difficult because obviously everything kind of 3 out of 4 stocks are going to follow the market, right? So when the market's down 35%, lots of the leaders, the past leaders, are going to be down 50%, 60%, and we've seen that from some of the high-flying tech stocks of 2020. And then macroeconomic analysis, we'll get into this. Clearly, that's having a huge impact on the overall market right now. I know as me and my dad were talking about, ahead of the inflation report, we wanted to, we had dipped our toe in, we even lightened up ahead of that. Which is interesting because, for us, we're sitting here talking, expecting a hot inflation report, right? Like that was our base case, that we were going to see acceleration in May, just because we follow this stuff so closely. But obviously that was a influential moment this past week. And then just as a, kind of a guiding post, another one, these are certain, asset classes that we want to focus on that typically will do well in certain environments, and we kind of think of ourselves right here. We're in this quad 4, and that's with decelerating growth and decelerating inflation. I know we just saw it accelerate, but we have every expectation really for the Fed's actions to work, put the brakes on inflation, put the brakes on the economy. And typically, you're going to want to be exposed to the dollar, gold, and fixed income. Unfortunately, the fixed income aspect has not been a safe place either in this environment. but you know, it's hard to find a direct comparison of the environment we're in right now. So it's just been a little different this time around. So that's why, you know, we've really been heavy in cash. And gold maybe does work eventually. It's one of these amazing looking sort of stock bases, right? Chart bases that we'll take a look at too in the long term. But you know, for now, it's hard to get too exposed, especially with the dollar strengthening and rates going up still. Okay, so here is what we talked about on Friday. This big CPI report, I think it was 8.6%. That was up from 8.3% in April. So of course, there's no reprieve yet. A large portion of that, we're seeing rent roll through. We're seeing, you know, higher rents. We're seeing higher food prices, and oil has yet to let up. So you know, there's still obviously a lot of work to do, and you know, with that, we see, you know, higher prices, wages not quite keeping up. And so this is, you know, the look at real wage growth, real hourly wage growth, less the you know, wage growth less the CPI. And so that's what we started seeing here in as early as April of last year, real wages actually declining. And so, you know, the consumer is not in good shape. Just a month ago, I think Jamie Dimon or, you know, a bunch of the other bank CEOs are saying, hey, the balance sheets are great. Well, they're great for now, you know, and until you draw down on those, of course. And I think he pivoted a month later and said that it's going to be a hurricane. So I don't know what he saw, you know, on that whatever, a month prior to that, but this is what, you know, this is what's concerning. This is what the market is discounting right now, or that's part of it. And then with that, you know, as real wages are declining, this is pretty large consumer credit growth, you know, the highest we've seen in 20 plus years, and that's consumers filling the gap, of course, with you know, with prices just unhinged a little bit right now. So that's obviously a bad sign. That's I would think an early leading indicator of you know, what could become of the consumer in the next just few months or so. And then along with that, you know, all the another headwinds to the economy that we're staring at, of course, is mortgage rates. Those have spiked. They surpassed 6% after the Friday report too. They were hovering around 3 or 5.2. They went up about 1 percentage point after that. So just one other, you know, economic headwind. And then no surprise, you see consumer sentiment really close to multi-decade lows here as well. So again, you know, these are all the things that are in the macro backdrop that keep us cautious for now.
And Wes, back up, is that
Yeah.
Those are the recession periods that we've gone in recession after the University of Michigan consumer has
Yes,
bottomed?
they are. And I wouldn't necessarily say, looking at this, that it's a leading indicator of any sort. So maybe, you know, what we might see is that in retrospect, this area could be grayed out. You know, we saw Q1 come in as a decline in GDP. So, and Q2, you know, we'll see. Maybe we're in the midst of that recession right now, right? Because I mean, what do you say to have this to me looks like it's not necessary. I mean, this maybe led. I wouldn't say this one led too much. You know, I'm not sure if that is. This doesn't look like it led by a huge amount, but yeah.
What we do know is that if consumer sentiment is very, very poor, the consumer is going to start pulling in their horns. You know, they're going to stop spending. And so with that, you know, that hasn't shown up yet, but, you know, we're on the cusp with interest rates rising the way that they have, of the consumer just shutting it down.
Yep, absolutely. Yeah, for sure. And the first places I assume that really has to come out of is going to be those large discretionary purchases that are purchased on credit, homes, cars, maybe big items for your home. But you know, that can have a very quick effect, I think. And maybe that, that's the whole point. Maybe we are in that recession because maybe it just has already had that. And but we'll see. If the sooner it starts, the sooner it's over with. Hopefully so. Along with that, what's the Fed going to do? Right? We know the consumer is not in great shape, and that has a lot to do with inflation. This is the most recent data point of what they're expecting to have the Fed funds rate at by December. So updated as of today, they're expecting to be at 3.5% by December. Currently, we're right here. We're at 0.75 to 1. And then as early as tomorrow now, they've revised, the markets are now pricing in a 75 basis point rate hike following that CPI report. Jerome Powell had previously said 75 was not going to happen. That was apparently why it rallied last Wednesday, right? Or the last rate hike. That was the thing that people in headlines grasped onto. Oh, it's not going to be 75. Well, it is going to be 75, and it's going to be tomorrow apparently. So I guess they'll be data dependent, and they can't back off. They really can't. So I think this is obviously got to be the base case that now the markets are going to be expecting 75 basis points.
Wes, what's your view on the next couple of Fed meetings after tomorrow?
Yeah, I think I think you have to do another 50 at least the following. And I think, I don't know, I can't see too far into the future there with that. But, for me, the working base case is going to be, again, 50 basis points in July. I'm not convinced that they will, it depends on the destruction of like asset prices, I think, too. But it could be quicker than expected that they can let up. But, there's the possibility that the only way they get inflation under control is to raise the Fed funds rate by or to a rate that's above inflation. Now I can't remember what we were looking at, but in the past, when inflation has gotten above 5%, right, we've needed to raise to a Fed funds rate that's above that inflation rate. So, with that outlook, you might see it get to 4% by the end of this year. You might see it get to 5% at some point next year, and then hopefully, they meet in the middle, right? Where you're obviously not going to bring the Fed funds rate to 9%, right? You wouldn't want to do that, but maybe they actually make some progress with things, and they can meet somewhere between this 2%ish range and 8% where it is currently, or where inflation is currently. I think, I don't know, I'm slowly starting to convince myself that oil is the most important chart in the world. And, if that breaks, then there might be then I feel like that will be the leading indicator, right, of inflation actually peaking, if it breaks in a convincing manner. Because we're not going to sit here and wait for inflation to actually come down to 2% to start investing, right? You just need to see a sign. And if the Fed needs to see visible evidence, of their policies actually having an impact, I assume, markets are going to jump that, they're going to be ahead of the Fed's thinking on actual progress. We can go ahead and discount if we see, commodities peaking and all that and rolling over. But the Fed will maybe have to continue and overshoot. They overshoot a lot of times. So we'll see if they can avoid that problem again.
Yeah, Stan Druckenmiller, the famous legendary hedge fund manager, came out a few days ago at a conference, and he pointed out that with an inflation, once inflation exceeds 5%, there's never in the history of our country where the Fed has engineered a soft landing. So I think anything is possible, but I think it would be very remote that we would get through this with a soft landing. I think everything that the Fed's doing, it's accelerating that. The rate of change is happening quicker than normal. We've had the greatest rate of change in terms of Fed funds ever of all time. And the Fed is now, they're backed in the corner where they've got to catch up with everything. So that's going to put us in a recession if we're not in a recession right now. And if we're in a recession right now, that does have economic implications, and it has implications to the market as well. But we really think that the market is discounting that recession right now. And we'll talk about that in terms of what your downside target might be. But we have a feeling that the downside can be placed in quite quickly, and this can happen judiciously.
Yep.
Hey, Roy, it's Larry. I got a question for you.
Yeah, hey, Larry.
I keep always hearing hard landing, soft landing.
Yeah.
What's the boundary condition between the two? Is it when if they declare a recession, does that mean it's a hard landing?
Well,
do we have to avoid a recession to get a soft landing? They're
going to the politicians and the Fed. They are politicians. They're going to, and you're going to hear a lot of Wall Street firms that also talk about a soft landing, and that's a recession that's not that deep and it's not that long. And that's we are in a historical period because there is no analog in history that we can, use to guess, what is it going to take for the Fed to thwart inflation? We don't know how long this is going to last. What we do know is, the market is a discounting mechanism. And there's been, this is the third worst bear market in my history that I've experienced in history over 3 decades. And we're in it right now. And the market is quickly discounting this. We've never seen the markets discount something like this quickly. And, we didn't, in the 87 crash, we didn't have a recession. In 94, we didn't have a recession. But I think that the economic news that's coming and the slowdown that's coming, and the news that's been leaked out by companies like Walmart and Home Depot and so forth, the selling that are the firings that are going on in technology companies, I think that's going to lead to an abrupt halt in economic expansion. So I think this is going to be probably a doozy, in terms of recession. But how far can the market go, and how far can the market go down, and what's the how does the market discount that? That's what we're trying to get a hold of right now. But I think this is going to significantly impact GDP almost immediately. GDP was down 1.6% in the first quarter, and I think we only have a couple of more weeks left to go in the second quarter. And I view things have I believe things have deteriorated in our economy in this quarter versus the first quarter. DeMartino Booth, who used to work for the Fed, she's an economist. She believes we're in a recession right now. I don't see how a lot of Wall Street firms don't view that we're in a recession right now. I think I think the numbers are going to demonstrate after the quarter's over, but that's going to be released in July, that we're in a recession. If a hard landing would be predicated on, well, how long does that last and how deep does it go? So right now, Wall Street doesn't believe that it's going to be hard, but we think that it can be material.
Oh. Whoops, sorry. Let me see what's going on here. I'm sort of stuck here. Oh no. Oh. Okay. All right, technical difficulty here.
Well, let me ask a quick question while you go through that. Roy, can you expand on that a little bit more? Like what scenarios are you kind of playing out? Like, if this were going to deteriorate, like how much more do you think the indices will go down from here?
I think, and I've got a lot of levels that I've got in mind, and there are a couple of levels that I'm looking at. I'm looking at the 50-month, and that's about 3,400 on the S&P, and it's about 10,600 on the Nasdaq, and that's been the trend line going back for the last 14 years. Now, that's one level. That's an imminent level that we might hit imminently. The other level that I would look at would be a Fibonacci retracement of that 61.8 area. And that puts us, well, I'll pull it up. That puts us at, I think 98.50 on the Nasdaq and 3,200 on the S&P 500. We'll have to look at that. I've got it on the other chart, so we'll take a look at that. Wes, are you there? Okay, Wes is rebooting. While he reboots, let me go ahead and pull that up, guys. So let's take a
Somebody
look.
was asking about a soft recession and a hard recession. So
Yeah.
soft recession is controlled by Fed. So they can control every aspect of how much market goes down and how much they want to prop up and come back and so forth and so on. If it goes out of control, then we have a hard recession like 2000, where market went down by 80% and there was no control whatsoever. Same thing happened in 2008. It was beyond the control. That's why market dropped significantly within a span of 18 months. So right now, Fed is trying to gain control so that even if we have a recession, it will not drop that much and it may not linger that long. Whether they will be successful or not, that remains to be seen. And I believe somebody was asking what is defined as a recession. So 2 consecutive negative GDP numbers define recession.
Now remember and Wes, I see you're back online. Remember that, that's the typical definition of a recession, 2 negative quarters of GDP growth. But the Bureau of Labor Statistics looks at it a little bit differently. So the Bureau of Labor Statistics, they're going to come out and dictate, that language. But, what's going to happen is that's going to come out much later, after you've been, clearly in a recession. And, certainly I think that we potentially could be in a recession right now. Are you guys seeing my screen on the S&P 500 right now?
Yes.
Okay, so this will give you
the
an
background
idea.
is pretty black. It'll be good if the background can be white or something.
I cannot change that on this screen.
Okay, thank you.
So this is going back, and we're looking at the weekly, and I've got a Fibonacci retracement. So you can see a 38% retracement there. It's at 3,800. The 50-month, which is equivalent to the 200-week, that's down at 3,500. And then you have another level down here at a 61% retracement. That's roughly 3,200. And keep this in mind too. When you're trying to estimate or guess, what levels might hit, it does, earnings do have to fit into the equation. And right now, according to Zacks, the consensus estimates are about 200. I think Zacks has it at maybe $219 in terms of earnings for the S&P for 2022. Now, if we're in a recession, I think that earnings are going to drop at least 10 to 15%. So you take 10 to 15%, let's just say we come in with $200 in earnings. Well, if we're in a recession and earnings are dropping, the PE multiples got to contract. We don't know what those earnings numbers are going to be, and we can only look historically on what PE levels have been in the past. And typically in a recession, it might be 13 to a 15 number, 15, 16 number, say 13 to 16. And right now we're trading at 18 times of future earnings. So if earnings come in at 200 at a 16 multiple, that's a 3,200 S&P. So that's how, so the modeling will be predicated on, how the company does, and or how the country does in terms of continued growth or not. But the market tends to overshoot. What we're doing right now is basically coming back to trend. But, you can see support on the market on this chart right here. It's roughly 3,500. The next level is that 3,200 area. Now, this is on the S&P. If we take a look at the Nasdaq, here's the Nasdaq, and we're right at the 50-month right now. And when we go down, if we look historically, this has been a period where we've been in this major uptrend, and now we're just coming back to trend right now. So if you run those Fibonacci numbers on the Nasdaq, we're at support right now, and then you just start looking at the next level. We broke out. If we go back to the pre-pandemic high, that's about 98.50. So we have about, we potentially have another 10% downside, potentially quick, that can happen quickly. Like, I'm talking about we could be 5 to 10 days from putting in the bottom as the market discounts that. And the reason that we might think that is because of some of the sentiment numbers and some of the breadth numbers that we're seeing currently. But, we're at support we're getting there on the NASDAQ, and, the NASDAQ's down about 34%. If the market goes down another 10%, that puts the NASDAQ down 44%. The S&P's down about 22. And we see downside on the S&P another 10 to 12%. And that puts it down to 30%. And Wes will show some slides about average bear markets. So we'll come back to this with that in mind. Wes, I'll go ahead and turn it back over to you.
Okay. Thank you. All right, we're back. Yeah, I'll just start right there. I mean, this is some data we were looking at as far as like standard, or I don't know, the past NASDAQ bear markets. And so just to note, this is a bear market without a 20% rally. So that's why we have this kind of .com issue, multiple bear markets, because they actually, were some pretty strong bounces throughout that period of 20% or more. And so, if we consider that, we're sitting here on day 168 of this bear market, down 33%. We're pretty close to that average depth in the NASDAQ. And, maybe a little bit longer to go if this is going to be maybe an average one. Of course, unclear still, but, we're close. I mean, we're like you said, maybe that 10% more move or 15% more move could happen quickly. Things seem to happen quickly more recently. And I thought this was an interesting chart from Ned Davis Research, and it just puts this one into perspective. It's a little old now, so it's been a few more days, and this is the S&P. So the S&P, is now down like 21%, but wasn't at the time. So, if we were to stop here with S&P, it'd be actually a pretty tame bear market. It would be below average for a non-recessionary. It'd be short and quick for a non-recessionary bear market. But if you notice, the depth and length of average bear market with a recession, much longer, much deeper. And if we're looking at a recession, we expect, one of two things, right? This, I guess it could prolong, sure. But we think more likely is you just get that depth, that selling pressure, to get to something more severe, potentially. So, but I thought a very interesting visualization to help you put this into context, again. And my dad, I know, touched on this, right? Talking about the 50-month. I was going to mention that, but maybe we're right here. Maybe we're almost done with that second big sell-off and close to that bottom. Choppy for the last 6 months, and then much steeper declines the last 2 months. But this just, I don't know, this parallel that kind of looked similar to that major 2008 bear market. So just thought interesting comparison there.
Yeah, no, guys, remember that, anytime you look at the analogs, when people want to compare this market to other times, and there was a question that was posed in the chat box, this is unprecedented. We've never had a period where the Fed is quantitative tightening at the same time that the economy is slowing, and that's, that has recessionary implications. Normally a recession adds another 10% or more. And if we have the great, if this would turn out to be like the great financial crisis, this can last for quite a bit of time. But I think technology is accelerating everything, and the market is pricing all this in, more quickly than ever because of computers, really, because of algorithms and computers. So remember that when you take a look, and the chart before showed, what the market, if you want to look at, well, where's that chart. See, this is more, if you want to see, well, what does this market look like? Well, it looks like just like 2011. Yeah. And I think that's 1970. Is that 1973, Wes, right there?
I guess it's 71, I think.
71.
Yeah.
So those are the analogies. So what everyone wants to do is that you want to compare this to the 2000 to 2002 top and the 2007 to 2009 bear market as well. But you necessarily can't do that accurately. Remember, these charts just reflect what the behavioral results of the participants that are looking at them. In other words, the charts just show you and demonstrate just the supply and demand at different areas, and it shows you the behavioral implications and how the participants react, and that's what creates the chart. So don't necessarily get hung up on finding the exact analog, but it's useful because you can see what other technical indicators, what kind of information that provides you to really find out what's the best way of managing risk in your portfolio. And again, this is, I haven't experienced this since 2007 to 2009, the devastating that's taken place in growth stocks, where many growth stocks are down 70, 80, and 90%. Haven't seen that in 14 years. So that's what we're going through, but this is, we're in uncharted territory. And so, you just have to just survive and navigate through this. When the bottom is in, there's going to be tremendous opportunity. Those true market leaders are going to be all over the place. And remember, just as a point of encouragement, from that 2008 bottom, remember the QQQ went up for 14 straight years. So once you wring out all the excesses and the liquidity and the buy to the dip mentality and put in that bottom, then that's going to set the stage for potentially many years of positive performance going forward. So if just remember that if you would have bought the QQQ at the 2008 bottom, you went up, your portfolio went up 500 or 600% over the next 14 years. So, so that's the good news, bad news scenario. Go ahead, Wes.
Yeah. Yeah. And then to add to that, the first years of these bull markets can be great, right? So, that's just adding to the encouragement. Like, keep doing your homework, right? We'll keep meeting, we'll keep sharing our ideas and everything, and be ready for the next bull market for sure, because this is the first year can be a life-changing too, right? So if we're up 42% in a year, ideally these true market leaders are going to be up 80%, right? So that's just to piggyback on that.
The market leaders are going to go up, and and many of you that I've spoken with before know full well, coming out of a bear market like that 2020, you had a triple digit year, a year and a half there, and it's going to be, you'll be able to do a multiple of the S&P 500, and what's important is to be there for the first year. So you've got to continue to do your homework here, and test the market, test the follow through days. We're getting down there in terms of a lot of different signals that suggest that, that a bottom might be close with one more move down, particularly if it's panic induced. But then it's going to turn around and it's going to be just, you're going to have tailwinds for the next few years, and then it's going to be all worth it. So, stay in there, hang in there, don't give up. All of us have lost some money, in the bear market, but it's going to, you'll be able to get it quickly on the return. I remember in 2007 and 2008, I lost 8% both years. And so I had about a 16% drawdown, and then I made it up in 3 months and just had a terrific run after that, and had a number of triple digit years. But you had to survive 2007 and 2008. But then, you made it all up in 3 months, when the low was in. So keep that in mind.
Okay. And this is just an ending quote sort of for the first part. Tell me how people are going to think differently in 18 or 24 months about the situation than what they're thinking now. Do not invest in the present. Present's not what moves stock prices. Change moves them. And try to envision a world a year and a half from now and what that will mean for security prices. So I just thought that was a nice quote from him from his recent interview. Just a reminder, because sure, like right now, maybe things are a little dismal on the macro front, which they often are, honestly. But so you don't want to be too much of a macro guy, really, for that reason, to stay negative. But what are the things going to be? What's going to be different? I don't know. Maybe we're talking deflation a year and a half from now, as this asset bubble has been unwound. Maybe that's a big driver for a huge deceleration in the CPI. Maybe China is the next. Maybe their bull market is starting right now, and they're going to have a massive reopening and resurgence. And trade relations are going to be dramatically improved with them after people just considering them uninvestable for the last 2 years. Maybe that's the driver of improved supply chains, that they actually realize the importance of reopening. I don't know, just things like that. Something to think about. But I like this.
Wesley, can I ask you a question?
Sure.
First of all, how you doing this evening? It's Chris.
Great,
from
great, Chris. Thank you.
That's good. How you feel about the VIX? Because it's confusing. Because I think with the VIX, like it's like orderly selling. One part of me see it that way, like it's orderly selling, but a second part of me seeing like, okay, GameStop still be going up while the market be getting crushed, like stocks like that, the mini stocks. I feel like I feel like them stocks got to like flush out and really get hit hard before we get a bit like a real bottom. That's just my opinion. How you feel about it?
I think we would agree that there's got to be more of a spike, and that's one of the things that's one of the charts in the back that we can touch on again. Totally agree, right? I mean, I think most people would want to see something above 40 in the VIX. Yeah, I don't know what to think about GameStop in particular, but a washout of maybe the larger cap names to accompany that VIX spike.
Well, I was just using GameStop as an example. I just feel like some of the stocks still be holding up. Like when the market getting flushed, like for instance, I think it was Thursday or Friday last week, the market was just getting flushed. GameStop was like positive most of the day. I think it might have finished flat. And the market would get like the Nasdaq was down like over 400 and things like that. And a lot of those stocks be holding up while the market be getting flushed. I noticed. I don't trade them, but I noticed like I be watching their price action.
Yeah, that's one of the things we're definitely looking for every day. Though, like that would be a positive thing for us, right? We want to see that for sure as the Nasdaq and S&P are making new lows. That's like the most important, I think, screen that we're going to be making as we look through stocks, is those stocks that are holding up, because obviously something special is happening. I don't know about GameStop in particular. That's wild to me, but for sure, that's what, that's one of the things we focus on. So, but yeah, I don't know. Dad, do you have anything to add to that?
Nothing to add right now. Just let's, go ahead and move forward.
Great.
Yeah, it's Larry. I got a thought on this, and I guess it's not my original thought because I've just been hearing it around, is that since we've been in such an orderly decline, does it really make sense that we can actually get up to a 40, 50, or 60 number that we've seen before? Because in those times, things were crazy and moving very, very abruptly.
Right.
I think they can, Larry. Yeah, I think they can. And I think, I think the next few days might be extremely volatile where that might happen.
Yeah, and what the VIX, the Nasdaq VIX has been up at above 40 multiple times. So we talk about the VIX a bunch, but maybe we can if we look at the Vixen, that's elevated to levels of the 2018 bear market and the early 2018 spike too. So maybe that could show signs of capitulating first, and maybe it takes one. I mean, I know we were down 5%, right, like 2 days ago, but if you get 8% down day, I mean, I guess that's what would have to make it happen. But
yeah, but it could be a cascading effect. I mean, particularly if it happens quicker, and it just, right now we've had this, bear market that's just, there hasn't been really a lot of buying pressure at all. And I think there could be some dislocation. That's what happened in the 2018 bottom and the 2020 bottom. There was some dislocation that took place. And we've got the perfect storm for that happening, just depending on what happens with the Fed. I don't think there's going to be much of a surprise after they leaked the story to the Wall Street Journal yesterday that they're going to raise rates by 75 basis points, but it's how the market reacts to the information and news that is important. So we'll just have to, we'll have to play it as we see it, but I don't think a true bottom will take place until people finally give up on buying the dip, and just the fear is pervasive. We get a couple of, anything can happen. The crash, in 1987, I think we were down 27% in a day. Anything can happen because this is truly unprecedented with what we're going through right now. So let's move forward, Wes, and we've got a few more slides to go through before we.
Yeah, I can go through some of these typical ones a little quicker. We've obviously S&P 22% off the high. The Qs 32.5% off the high. FFTY, our stalwart of growth names.
Yeah, and by the way, on the FFTY, this is true. This is a true indicator representative of what's happening in growth. Now, this is this has far exceeded the drop in the 2020 bottom and the 2018 bottom and the 2015 bear market as well. I mean, this is unprecedented that we've had a 43% drop in the index, because remember, that suggests that many growth stocks are down twice that, because that's because of the debate on growth stocks. So that's how difficult it's been in the typical growth stocks, other than the big stalwarts, the big, Apple, Amazon, Facebook, Google, and NVIDIA and so forth, but they're coming and getting those right now. And what might happen is they might continue. And what happens at market bottoms is all these stocks don't bottom at the same time. So the indexes can go lower, but some growth stocks and new leadership can actually hold up. So you want to watch the stocks. You want to screen for the stocks that have high relative strength, that are holding up. And there are very few that are holding up. But when you go back and you look at these prior bear market bottoms, and you go back and look at the leadership, like I encourage you to study TTD Trade Desk, NVIDIA, Tesla, Shopify at the 2018 bottom, and take a look at those, because they weren't near new highs, and it took a little while for them to go. See, it may take, once you have a follow through day, it may take another 3 or 4 months. In the 1998 bottom, when the market bottomed in October, you didn't really have a lot of breakouts until April. It took 3 or 4 months for that, for the new leadership to show after the bottom took place in the indexes. So right now, really what we're concentrating on is trying to find the stocks, and we can't find the stocks yet. Find the stocks that are going to be the next new market leaders. There are very few stocks that have triple-digit earnings and revenue growth right now. Mm-hmm. And I see a question regarding IPOs. IPOs certainly might be a source of new leadership there will be a number of leading stocks from IPOs that have taken place in the last couple of years from the bottom. Mm-hmm. Go ahead, Wes.
Yeah, and we obviously will talk about a few on our radar. Okay, similarly, just the IBD mutual fund index, not bad, but 35%, and just some of these components of that index, and again, just reiterating.
Those are the top. Those are 18. I believe that's 18 of the top 18 to 20 of the top performing mutual funds with the best 10-year records. So you can see if you've had, this has been devastation. These are the guys that have the best 10-year records in the industry. And that's what's going on through. That's how this market has, has crumbled. Normally in bear markets like I remember 1990, before Iraq invaded Kuwait, before we went to war, the Gulf War. In most bear markets, these indexes were down. They typically are down 30%. So across the board, so we're far exceeding that. And if we do have another 10% drawdown, you're going to have most of these with a 4 or 5 in front of them. So this is, again, these numbers suggest that this is the third worst bear market that we've experienced in growth in the last 30 years.
Okay. Okay, chart of the Nasdaq and MACD, just showing a MACD at a sell signal. Just 3 days ago, 2 days ago. Relative strength still not oversold based on that, but it can maintain an oversold level if it does reach that level for some period of time. And again, the crossovers, which is what we consider sort of intermediate term, getting you out early in the year, January 5th, I believe, or 3rd. I think 3rd for the Nasdaq. And then, along with the follow through day, kind of pulling you in March, and a clear exit signal as the intermediate term changed again, again, keeping you out. It was unclear how this would resolve itself. But, I think this break below the low and break of the follow through day low was kind of enough to say, hey, that there's a high probability that the last follow through day would fail. There's that. Okay, and we're talking about these washed out levels on some other indicators. We're sitting here at under 5% of the S&P above the 50-day. That's really comparable to the last couple bear markets where we saw a bottom. We finally hit that level. The Nasdaq, I think, was closer to that, and just oil names, defensive names really held up that number for the last month or couple months. But we're really approaching some extreme levels, and it could hang around here for another month, or it could be quicker. I don't know, but similarly, we'll see this a little bit more of a lagging indicator, but clear break there to that low 17% number. Got somewhere, I guess that's close to 2% in the 2020 bear market, and maybe 10% in the last 2018 bear.
Now, and by the way, guys, in 2000, at the 2008 bottom, we were at 0 on those levels on the S&P above the 50-day, and the number of stocks above the 50-day and 200 were at 0 at the 2008-9 bottom. But again, we 2007 to 2009. You didn't have that many growth stocks that were down 70, 80, 90% either, and that's what makes this such an unusual market, because we've seen all these prior leaders that have dropped, so much.
Okay, in the Nasdaq, obviously with the last bounce, got up to 30% of stocks above the 50-day, back to 14%, and lows in the single digits. Something that you'd maybe look for a real washout on that level. 200-day, similar idea here. We're sitting at 10%, and then really just got slightly below 10% on that sharp COVID decline, and right at 10% on the 2018 decline. And this the advanced decline line. So the S&P, we realized for the last year and a half, or throughout 2021, the advanced decline line was really confirming the uptrend. As it made higher highs, the indexes made higher highs. We saw that start to roll over, and it's flattish, the advanced decline line, but break into a lower low here with the indexes. So kind of confirming the widespread, I guess, decline in the S&P. I remember we were calling this out throughout last year. The difference here being lower highs in the advanced decline line, while the indexes continue to march higher, make higher highs, just showing, it's a warning sign that the market was not healthy, that it was narrowing, a few large leaders just leading the market forward. So that's why we monitor this. When we look at net new highs,
quick question.
Yes.
Quick question. So I have done extensive study on the AD line, cumulative AD line, and if you go back more than 20 years, so if you go back to 1998, 97, 94, it doesn't hold well, because the AD line continuously keeps going down versus market continuously keeps going up. So you need to be careful when you're looking at it solely, because at times I've seen that it will continue to move down, but market will come back up and keep making all-time highs. And if you rely on the AD line, you will miss out the entire rally.
Right, and that would be, you're right. That would have been the case here, right? If we're refusing to participate because of that, right? But yeah, it is. Yeah, that anything to add there?
Well, notice, I think this is important to notice when, if you look at that February top and looking at the, that's, we had a number of accounts. That was the top in growth right there. That we had a number of accounts that peaked right there, that were in from the bottom, the March 2020 bottom. And then you came back and, made, close to making a new high there in November. But notice the advanced decline line, it was much weaker, even though the indexes were in November were hitting new highs. That's because they had not gotten Apple and Amazon and Google yet. And, the big cap, NVIDIA, the big cap tech. And with that advanced decline line, what it shows you, it just shows you the distribution that's taking place from the market bottom. But I think it's also important to notice that these averages are still in downturns. You've got a rolling, 50-day, you've got a rolling 200-day that are in downtrends. So you need a little bit of time for the trend to change. So I'd be very careful in terms of guessing the bottom before a follow-through day again. Because you don't know where the bottom is, particularly where when the slope of those trend lines are still down.
Yep, and steep.
And steep, yeah.
Yep. Okay, another breadth indicator we're looking at is the net new highs list and net new lows. So right here on the bottom, just being the new highs minus new lows. And again, this is another warning sign, right? Another thing to be wary of. As you see in November, like we were showing the indexes top, lows are outpacing highs, and that's just continued for 7 months or so, and that obviously a hard environment to make money in. And we'll look at this in context too. To give you, I actually have a 20-year chart on this one too, so we can take a bit longer look. But we've seen that multiple times, that relative level of new lows in this bear market. 2020, obviously a huge whoosh, and nowhere really close to the 2018 bear market. And then longer term context, we can see again in 08, not even quite at that same level that we've seen more recently in the net new highs number. So more signs of how sort of extreme it's been, and just continuously monitoring, if we are, just trying to understand how, the bottoming process in context of everything.
So let me make one point on that, folks, and that is, to me, this is one of the most important indicators to use. It is almost impossible to make money when you have more stocks making new lows than new highs. So you can see, just from a context standpoint, you can see the cluster of this year and the net new lows that have taken place. That's been, it's been merciless in terms of the distribution that's taking place under the surface. And we won't have an easy dollar environment until that turns into a mountain of blue. But what you want to see is the new lows dry up to under 40 for 4 or 5 consecutive days, and that's going to tell you that most of the selling is done. And this is intense selling that's taking place when you observe the stocks making new lows. That's why we think that we're potentially very close to a bottom in the overall market, not necessarily the indexes, but the overall market. We think that we're very close to having most stocks put in bottoms down here because of these breadth indicators.
Mm-hmm. And Chris, like we kind of touched on this with Chris's question, the VIX, still not really spiked. I wouldn't we can't expect it to get to a COVID level because that was unbelievable uncertainty, but would still like to see something more elevated to signal that more fear, and we'll see if we get it, but that would be one other thing to look at to try to determine if we've seen that bottom or not. This is something we check every week too. It typically updates Tuesday or Wednesday, but this is, I think, last week. We saw active managers get pretty low exposure just a few weeks ago at 20%. Naturally, as the market's bounced and you think maybe the worst is over, you increase exposure. So we're back at 50%. Would not be surprised, of course, to see this drop hugely this, as soon as the next week of data is reported. But of course, this will be something to monitor for a bottom to be in when all the active managers are in cash. Similar to us. And then I'm just going to skip to this one. This is the bear bull sentiment. So bears on a net basis clearly outpacing the bulls. Not a good timing tool, right? Because that's been the case for a few months. It might even be close to a year at this point. But again, more signs of extreme. You compare this, this bearishness to where we are, or to where we were in 2009, to where we were that's in 1990. Even 2020, I guess there was no time to get bearish. It just, the survey is probably only conducted every so often, but yeah, this is something, and it is very extreme right now. It doesn't typically, you'd think that was the low, and that you could see a rally off that, but it's just so hard with the Federal Reserve backdrop that we also have, and might require even more bearishness at this, just in this particular cycle, because of that Fed backdrop. That's such a such a headwind for the overall market too. Okay, the put call ratio is a 5-day moving average. It's perked up recently. I think the daily value could have been 1.3, but this is a moving average, so it's a little lagging. But definitely great to see that as well. You want to see more extreme level, and just looking at the last couple, that spiked to 1.4 or so. So we're maybe we're getting there with this measures too as well. And then this is just another sort of source. It's the equity put call ratio with S&P below. Just again, trying to put this move up in context. And the put call ratio, another common thing just to monitor.
Have you noticed that in this put call ratio, the entire spectrum has moved down during 2021? And if you go back in years, you'll see the rest of the spectrum stayed in a range, versus for 2021, that entire spectrum moved down. So we are like in a new set of rules now.
Right. Yeah. I that's evident here, right? I don't know what to exactly what to make of it, but yeah, relative to this sort of average level, it could be a similar type of, or it might be a lower spike relative to that level, but I don't really know what structurally changed, other than, I don't know. All right, and this is going on in the credit markets. So I think I'm pretty sure Neil flagged this for us back in a while ago, and this is clearly a concern for the overall market too. Credit spreads blowing out, just an overall barometer of the economy. Higher spreads, worse for junk bonds, and clearly showing some signs of stress in the credit markets. One reason why this is really important to watch too is because the Fed has, they've historically talked about credit markets a lot too, and they want credit markets to be working. whatever that means, it might mean credit spreads blowing out. It might, there's a line. I know if we can get some, if we have this longer term line, there's a good chance that the Fed steps in at what we might call the angst line. You know, they stepped in December as credit spreads blew out in 2018. You know, I wouldn't be surprised if they do something at 5.5 or 550 basis points of credit spreads on this index. So, you know, this is I think another really important thing that we need to look at just for the overall economy and understanding the Fed. You know, there's going to be a point maybe where this thing blows out and they kind of cry uncle. But I mean, again, it's hard, right? It's hard to know exactly what they'll do, because if they back off, of course, inflation maybe stays untamed. So maybe this credit spread level can actually remain elevated for some time. But I think it's really, I don't know, it's a really important indicator to be aware of. Okay, and the FFTY, like we talked about earlier, just on a recent sell with the MACD. ARC, you know, again, they're kind of the poster child of this bubble popping, 77% off the high. And just more context on a weekly basis. Of course, she says that her portfolio is going to be up tenfold. I write that tenfold in the next 3 years or 5 years. So she's I don't know, she continues to pound the table, because what else can she do? Bitcoin, I think, you know, interesting action the last couple days. You know, and I'm not sure, we're not, you know, we haven't plunged into this, right, this market, but certainly interesting. Looks like huge kind of capitulative action. It is kind of getting interesting at that level to me personally. I'm still like a bull on it, right? Like, I mean, I am a long-term bull on this stuff. And, you know, you hear all the bearish talk now, and Luna went to 0, and Celsius is, you know, banning people or barring people from getting their funds, and Coinbase is laying off people. And Coinbase said that, you know, they had that worrisome SEC filing about how, you know, the Bitcoin might not be yours if in a credit or in a bankruptcy event. So there's all this, you know, horrible news about Bitcoin, and, you know, some people being shaken, I know, for that are, you know, these long-term bulls. And I mean, this is just huge volume, huge selling that, you know, maybe the Bitcoin market can capitulate sooner than the equity markets here. And then the same thing with Ethereum, you know, really near record volume. Just, you know, this, you know, being a different animal, I guess, than the S&P, but I think getting close to real capitulation right there. And you know, where I'm personally, I would be interested in maybe taking a small position, but even though I don't enjoy, you know, it's not typically the thing to do, right? Buying the falling knife, but to me, this looks like pretty extreme capitulation, off 80% off the highs, and just massive volume the last couple of days. Gold.
One comment is on the Ethereum. I don't know if we can call it capitulation. If you see something like ELMS, that's the electric last mile solutions. Yesterday, it went down almost 99%. You know, Ethereum started off at 250 back in 2020.
Mm-hmm.
So there's no reason it can go back down to 250 or 300. You know, so I mean, these are in stage 4 downtrends. Even Bitcoin, you know, can go.
Oh yeah. I mean, yeah, it's yeah, I wouldn't plunge, but what if you're thinking 250 though? I mean, what is that, down 99.9%? I don't know. I still believe that this is kind of a game changer type technology. And to be down 85% when we're talking hundreds of billions, you know, close to $1 trillion, I think at one point for Ethereum. I don't know. I don't know if it goes from a trillion to 1 billion or 5 billion even, but I don't know. I think to me that looks extreme. I wasn't buying, I guess, this dip, but or dip crash, but I don't know. It is beginning to look interesting to me. Maybe we'll have some other opinions, of course, from anyone else on that, because that's always a hot topic.
Well, I believe that Bitcoin, if you go and look on Twitter and other places, people are calling, yeah, it will go to 8,000 and 4,000 and 2,000 and all kinds of things. I believe there are a lot of ETFs or what would you call that, institutional buying. Those are not just whales, they are like super whales, right? So they are all waiting for the capitulation to happen. And when will the capitulation happen? For most of the folks, especially Michael Slayer, MicroStrategy guy, I think it's somewhere around 21,000, which BTC has kind of come very, very close. In fact, it went below that level. I think in next down leg, or not necessarily a down leg, but even a couple of points here and there, it will probably breach that level, and it will be forced down to 19 or 18. And this will all occur on a weekend or a Sunday evening for a couple of hours, and we might see a big spike down to probably like 10,000 level only for like few minutes, and that is where all those institutional buyers will buy all that supply, because the margin call will be forced to liquidate whoever is holding at a higher price level. And that is the time when Ethereum might touch that 400 level, or I don't think it will go down to 400. It might go down to probably 800, because it seems like there is a support around that. So that is where a lot of people will buy it over there. But then it will probably go through a sideways chop for a long time. For like a year or two, it will kind of stick around between 1,000 and 1,500 and go back to 1,000, 1,500. And Bitcoin will stick around between like around anywhere between 1918 to 2022, something like that, and form the base. And then once the base has formed, it will start going higher. So that's what I believe will essentially happen.
Yeah, I think that could be true for sure with any kind of forced selling, temporary kind of extreme price dislocation. I think that, let's see, a few more things here. Just gold on a daily basis. It's one we looked at, really interesting on a long-term monthly basis, but just struggling to make any progress with rising rates. It's just it's really more of a currency, and as the dollar strengthens, which we've seen it really go vertical the last couple of days, it's hard for that for gold to really make any progress. But we're still monitoring it for the next leg, and then if you're looking at a long-term chart, it's just it's a 12-year base or whatever. So something that's going to be on our radar. And like I said, the U.S. dollar just spiking the last few weeks, just with higher rates being the driver there. WTI, we know this is kind of tapping on new highs, and a lot of those oil stocks have been working. And I said earlier, I'm thinking that this is going to be the most important chart in the world, just because if inflation is going to break, this has to break. So it's something that I'm gonna be monitoring, and but it's hard for us to really get invested in this. And I think we were talking earlier with Neil about how he went ahead and took his profits because look, it's worked, but you never know how long these oil stocks are going to work. You could wake up the next day and see something like natural gas. That's what it's hard to get too invested in these commodity sensitive names, because this is another thing you got to worry about. One announcement, one thing changes in Ukraine and Russia, and then that's it. That the party could be over there.
Yeah, you can make the case that nat gas peaked right there, down 16% today. You see the high up there at 950.
Mhm.
And that is what's going to happen to WTI. And there wasn't any news on nat gas today. We had an LNG facility that blew up in Texas, but that was a different, that really didn't have the supply and demand implication that you would think. You would think that'd be that would create a tighter market, less supply, higher prices, and it did just the opposite. So that's what you have to be careful of in terms of WTI. It's really one of the only components that hasn't peaked in the commodity area. So, but it's got a huge component, in the commodity, in the CRB index, in the CO. I think that's a COMM. That's BlackRock's commodity fund, and it's all energy. It's, I think, 61% of the CRB index. When that breaks, then you're going to see inflation break. And if oil goes, if oil goes up to 150 because of the supply imbalances, then that's going to put additional pressure, of course, on the Fed. They're going to have to, get even more aggressive to create and cause demand destruction. So
Well,
prices haven't created demand destruction yet, but if it stays up here for a sustained period of time, it will.
Right. Yes. And we touched on just the rising, spiking rates, 2-year yields, 10-year yields making new highs, and a 30-year yield also making new highs. We'll touch on maybe one or two more things, but the 10 and 2-year spread back close to inversion, which we know is sort of a leading indicator of a recession, and of course that's likely going to invert the more we the more the Fed commits to raising the short end of the curve. So that might be inverted for a prolonged period, especially when the long end starts catching up and pricing in a recession. So when the 10-year and 30-year starts moving down because of growth expectations coming down, that's when, of course, that will invert. Okay, and with rising rates, treasuries, treasuries have had a historically poor start to the year too. The TLT being 20+ year treasuries down 40% or so. And then high yield corporate bonds, so high yield and junk, also kind of showing crashing action here with just with those high yield spreads, the opposite of those high yield spreads we were just looking at earlier on. So credit is certainly sniffing out trouble, and when that happens, it's important to realize it's gonna, it's important for the S&P as well and stocks. So we'll see if the Fed can hold its ground. I think it's easy to say that they stand firm tomorrow, with their 75 basis points. I think that's the base case. But we'll see. Yeah.
Let me just add just a brief comment on this, on the JNK and the HYG. Remember, we've been talking, I guess it's been for a year and a half, that you didn't want to own any treasuries. Really cash is king, and then the equity markets are historically the only thing that outpaces inflation over time. But we're just trapped in this bear market, so equities haven't performed well. But over the last 77 years, of course, they've significantly beaten inflation. But don't get caught up, or don't get trapped or be misled if you see some of these ETF bond funds that are paying 9%, like this, that are paying 6 to 9%, that are potentially leveraged, and then you buy it for the yield, but you lose 20% of your capital, and that's the risk certainly in the JNK and the high yield marketplace.
Yep. Okay. Well, that's it. That's the rest of it. And I guess what we should take a break. I mean, yeah, we should probably take a break before we get into individual stocks then.
Yeah, let's take a 5-minute break, guys, and then we'll come back and I'll pull up. We'll go through, Q&A. We'll go through questions. I'll pull up Market Smith. The meeting concludes at 9 p.m., but we're going to stay later. Certainly, because we're at a historical period of time right now. We're going to stay late this evening. And we'll probably chit chat and really talk about a lot of individual stocks and have a lot of input from the participants here as we begin the second half. So we're going to probably stay, we'll stay to probably 10:30, but the meeting will officially conclude at 9 p.m. So let's take a 5-minute break and then we'll come back and hit it with Market Smith.
Hey, Roy, I got one for you.
Hey, Chris.
Hey, I got a stock ticker RCMT.
Yeah, thin stock, great relative strength. I've owned it before. Hold on, let me pull it up. Let's get going, guys. Okay. And thank you for starting off, Chris, with a great idea.
Oh, yeah,
Pull it up. Before I do that, let me point out this, guys. Chris, let me, that'll be the first stop we talk about. Let me point out this, and this is the Nasdaq going back the last 20 years or so. And this is actually the 50-month, the magenta line. So, you know, the reason that I've been looking at this 50-month is because take a look at this 15-year uptrend. These are bear markets. So the prior bear markets, you know, we've come down to this 50-month, and that 50-month, you can see it's 10,600 on the Nasdaq. So we are close to hitting that objective. I mean, I think we'll hit this objective. I think it's there's no question we're going to hit that in the next day or two. We'll probably hit it tomorrow. And the only question is, when you go back and you study and take a look on these charts on MarketSmith, when you take a look, see at the 2015 to 2016 bear market, that once you broke the 10-month, it took you a number of months. This was a fast bear market in 2020. There's the bear market in 2018. But if this happens to turn into like a 2007 to 2009, notice we hit the 50-month. You went sideways for 6 months, and then you cascaded down. So, and that's because the environment in 2008, 2009 deteriorated. So we're at a level where the market should bottom unless the economy really deteriorates. And that's what happened at the 2000 top too. So there's the Nasdaq, and I wanted to point out the same chart on the S&P 500. And see, there's the 50-month, 34.53 on the S&P 500. So, you know, if this is, that would be your downside target. Notice in the 2020 bottom, you exceeded that briefly, and then, and you had that strong rebound. So that's really, if this is a bear market like we've experienced in the last 15 years, then we're very close to the bottom. And, if we go through a 2007 to 2009, well, we're going to, we'll go lower. If we have a 2000 to 2002, we'll go lower than where we are right now. But I just wanted to point that out to you. And RCMT, Chris, let me pull this up on the daily. This stock broke out on earnings. It's a very thin stock. It only trades 283,000 shares a day, but it's very cheap and the numbers are great. This is a clear can slim stock because they've got accelerating numbers, earnings and revenues. And remember, we're looking for typically 25% earnings growth and 25% revenue growth. This company is coming in with a laudable 675% earnings growth, 84% revenue growth, while we're in a declining market. And look how cheap the stock is. They're doing about 300 million in revenues, a price to sales of 1 with a market cap of 234,000. This is a tiny company that's got really good numbers. So, this could turn into a behemoth. It's a thin stock, 10.1 million shares outstanding. It's got a 99 relative strength. And so it's definitely leading, it's leading the market in terms of relative strength. So, thin stocks like this may provide, they may give you a shakeout, but this stock is holding at the 21-day ESA right now. So this is definitely a stock to buy. Institutions can't buy it yet because it's so thin, but it certainly has great action. And notice where it broke out on the earnings. That wasn't earnings. Yeah, it was earnings on it, and it had that 10,300 that we talked about, where the price is up 10% a day and volume's up 300%. And so there's your classic 10,300 breakout right there. So this is a leading stock in the marketplace right now. But when you have thin stocks like that, they can have shakeouts as well.
Hey, Roy,
Yeah.
I was noticing, I looked at Yahoo Finance and Webull, that both of them were between 33% and 35% institutional ownership. So when you think institutional will get into the stock, when it
They're
get to a million?
not. You got 45 institutions in it right now. So that's tiny. No mutual fund, no IBD mutual fund index. They're going, I mean, that's way, they'll get into this stock when it's $1 billion, 500, $1 billion market cap, depending on the type of fund that they have. If it's, if it's a small cap fund, that typically is, 1 billion to 5 billion. So it's way under the radar right now. Now, that gives the individual investor tremendous advantage if this is, if this company is going to continue to grow. So, it's got to go at fourfold before the institutions will get into it. So that can definitely provide an individual investor an edge.
Thank you, appreciate it.
Sure. Guys, one of the things that CanSlim investors should look for all the time is triple-digit earnings and triple-digit revenue growth, and there are only a few. This is one, and I got stopped out of this 2 days ago, and this is a company that provides the medical imaging agent for CT scans. They launched a new product that's the standard of care for discovering or eliminating prostate cancer. So it's a new product that they're having great sell through. Notice the revenue growth, the last 2 quarters, revenue growth almost doubled. So that's not through any acquisition. It's not through a merger or anything like that. They actually had organic growth where they grew from 129 million in revenues to 208 million sequentially in the quarter. Notice the triple digit, 999% earnings growth, 126% revenue growth. And notice they have easy comparisons. So if they grew from 129 million to 208, and they do over 200, they're going to have another 100% revenue growth. And certainly they'll probably have great margins, great earnings with this as well. So this is the leading growth stock in the marketplace today. But if the market continues to shake out, you don't know where the downside is, but it should find support here at the 50-day. And notice there's the breakout where it had the 10,300 breakout. Volume was up 1,099%. The stock was up 39% in a day, and that was really the day to buy it. And so this is the leading growth stock in the market. There's not a lot of them, but this is one. Do any of you own this stock out there?
Yes, I still have it. Actually, I bought it because it broke out, but then it went down and I had a stop limit and it gapped down and my limit did not go through. So I'm still holding it.
Do you have a stop below this prior level right here, or are you just going to how do you plan on handling it? What's the best way?
Well, right now I've adjusted my stop below the current level.
Okay.
So low of the current level, yes.
Yeah. Unfortunately, I got kicked out of it. I got kicked out of it 2 days ago when it broke on no news. Just the market was hit there, and now I had a small position of. I only had a couple of percent in the position, but these are the kind of companies that can go up 4 and 5-fold from the bear market. So keep your eyes peeled on this one. So, if this stock comes back and makes a new high, it's a must-own stock if it takes out this, the level that it took out 4 days ago. If it snaps back quickly and takes the high out, that's going to tell you right there, there's big interest in the stock. This is another growth stock that has triple digit numbers, and I got kicked out of this stock as well, got stopped out of this the last couple of days too. I had probably a 2% position here, and this is the Monster beverage type company, and they've got triple digit revenues and earnings growth. So you have triple digit revenues and earnings growth that are accelerating. Notice the acceleration in revenues: 65 million, 94 million, 104 million, 133. So they're going to have easy comparisons, and they're making just a lot of money. And notice here on MarketSmith, where you'll have the 2022 estimate. Estimates are, it's got a green triangle demonstrating that estimates are being raised for 2022 and 2023. And you've gone through this long consolidation period where you're putting this massive cup in. And I bought this stock back here when it was going above the 200-day, and then it got kicked out. So, when this happens, either your timing's wrong or the market's wrong. So this is on my radar again. And if it's the real deal, and just look for the stock to continue to base out. But you had your crossovers. This is considered to be like a low cheat down here under 60, where the averages cross over, where the 10-day crosses the 21-day, but it was negated based on the market conditions that were presently, going through. So keep your eyes peeled on this one.
So do you have, to get out, do you have just a stop order, or do you have a stop limit?
Stop, a stop, not a stop limit. I got, because a lot of these, I got kicked. These things are just dropping. I get out at the market when they hit. I owned a Shockwave. This is the only stock that I held yesterday, and it got kicked out of that stock today. And it was the only stock holding up. This is a Shockwave Medical. They make a device to utilize sound waves to break up calcified plaque in the heart. And they've also have great numbers. You can look down here at the bottom, and you can see they've got sequential revenue growth and earnings growth. And then, then you just had inexplicable selling, and that's the market environment that we've been in. This stock bottomed, it's starting to firm up, and then you had inexplicable selling. And this is just like a mutual fund, just that needed to get out or had to get out, or, whatever. So, this is, you need to watch, be sure and pay attention to this stock. Notice the funds that are involved. That RCMT only had 46 funds. This has got 521, among some of the best performing funds in the IBD Mutual Fund Index. This is the confirmation that you want to see. These are the best in the business that are accumulating this company. I didn't see any news on it, so maybe news comes tonight or tomorrow. But they've certainly got the triple digit numbers that you're looking for. You want to look. The only companies primarily that have triple digit revenue and earnings growth, they're energy companies and oil companies right now. And you can see that, just like that UNG, see how that UNG peaked and just out of the blue down 16% in a day. And if you take a look at the USO, if they bust inflation, you see you had an outside day to the downside. That is a bearish setup when you, from a market top, particularly when it's 3 or 4 days from the top, and then you have an outside day to the downside where it tries to make a new high and they sell into it. So, this could be very important in terms of putting, you have big double top on the stock, on the USO ETF. So, I'm very anxious to see what happens with energy stocks. That might be a precursor. One of the things that Stanley Druckenmiller talked about in his presentation the other day was he was talking about companies that had earnings, not expectations, but they had basically peak earnings. And he mentioned that those were great shorts this year in 2022 because they had companies with peak earnings, just like you had the peak earnings in the COVID stocks. And those were great shorts at the top because they had peak earnings. I'm wondering, and I feel like the shipping companies that's been setting up, that these companies have peak earnings. And from the data that we've seen in terms of shipping rates, it's certainly showing you that shipping rates have come way down. So these companies aren't going to have the earnings or the margins. And notice the drop from the estimates. Zim is supposed to do $42 this year, but earnings are going to drop $67. That makes this a very dangerous buy down here. It's at the 200-day moving average. So these are the situations where you can see where you didn't have enough strength because they sold into it. Now that's the last 5 days, you have a tremendous distribution. So you don't want to be bottom fishing on companies like that. And, a number of these shipping companies have that same type of signature. So be careful, because of peak earnings. And I do worry about the energy stocks that I haven't played well at all that are in the Market Smith Growth 250. And let me pull this up. This has been the leading. So this is the Market Smith Growth 250. There's 276 names. This is comprised of 30 screens that IBD and Market Smith run that have everything to do with sales, margins, return on equity, debt, relative strength, sales growth, and so forth. And this is a screen that Mike Webster designed years ago. But notice where the energy stocks are the top performing group, and you're starting to see some red in here. So be careful that they're just, they potentially, a number of these potentially could have topped a couple of days ago when you take a look at them. That could be the top in Devon right there at 80. COP, that could be the top right there. And now you're seeing that USO turnover right now, but the energy stocks turned over 4 days ago. So Exxon Mobil, see, the top was 4 days ago. So this is the last group that hasn't been hit, except the coal stocks. I'll pull those up here. That's the number one group. So you got to be careful that, that energy stocks are printing peak earnings. So if they're printing peak earnings, you want to sell into the strength here. And that's not, no one's going to know that until later. That's, you have no idea. Well, you won't know, but the stock, the action, the technicals will tell you, but you can see, the numbers are, incredible, and they've got growth like numbers, but this is how growth stocks peak at peak earnings. The coal stocks as well that have had big moves. Look at this move from 70 to 150. There's a good chance that these, going from 50 to 150, that the coal stocks are peaking. These are the two big winners there in the coal stocks. I almost shorted this personally today, but I held off but a break at the 50-day distribution. Look at the volume, the selling volume over the last 5 days. So that's suggesting, particularly after the move, that's suggesting that this might be a good shorting opportunity right here. And where does this target go? The target takes you down to the 200-day.
Roy, this
yes.
is Dana. I'm
Hey,
still
Dana.
holding. Hey, I'm still holding Devon, and it does
Yeah.
look very choppy. But and I've read Will O'Neill. I really struggle with the selling into strength. Like I always wait until they start breaking down.
I do too. Like there's two ways of Dana of exercising your sell rules. One is like selling into strength, and the other is putting a stop in, and you're always, your equity curve is always going, it goes lower when you're waiting to get stopped out. But you'll never get the big move unless you put a stop in and give it some breathe and don't choke off the trade. But we've been in an environment where if you're lucky enough to make 20%, you take it. We haven't been in an environment because of the new lows expanding so much. It's certainly, there hasn't been a case this year where you've had a number of stocks that had doubled this year. When you have an environment like that, I think, if you're lucky enough to get a 20% trade, you take it. And now, when there's nothing absolutely wrong with this stock technically. But, if it breaks the support, then, if it breaks the support and you go down another 10%, well, then you can turn around and it's going to be down, 25% off the top, which is, we all deal with that. So it's down 11% now. There's no reason to sell this stock unless it breaks that 10-week and right there.
If you look a little bit closer on a daily chart, you will see there is a little bit change of behavior, especially on the volume side. You can see a lot of big volumes. So if you get any rally from this level, you should try scaling out of that position.
Yeah.
And have a complete stop below the current low level. So that way, if it drops below that, you're out of it.
Yep. Thank you. Let me point out a couple of things, and we'll get back to this. We'll get back to the energy stocks in a moment. But let me point out, this is really important. So you're going to have different stocks that bottom, but if you take a look, I want you to take a look again at the 50-month and go to the monthly. See, this is your downside in Apple. It's 100. It's $97. $97 is the 50-month. Now, for a lot of people, this has been the world's greatest stock, right, for the last 17 years. But at some point, they end. The leading stocks, I think there's a good chance that you could have made a material high on this for a number of years, in Apple. It's crazy to say that, but it's overowned, and they're warning. And, earnings and revenues are declining. When you look at the daily numbers, this is a company only growing 9% this year, which I think is high, and 7% next year. I have no idea what that 7% number will be. So you've got a growth stock that everyone owns, and you look at it on the daily, man, this stock looks sick, and the downside on the 50-month is 100. And so, can Apple do that? Well, there's Amazon. It hit the 50-month. So Amazon, I think there's a good chance that Amazon has made a material high. This could be a high for 4 or 5 years. As we rotate out of these stocks that everybody's been in, Amazon, Apple, Netflix, Google, NVIDIA, those 6 stocks represent, about 40% of the Nasdaq 100, a huge component, and they're overowned. But there's Amazon that hit the 50-month, and Google. There's Google, the downside in Google. See, if this market and particularly in growth. If rates rise, that's bad for long duration assets like growth stocks. There's your downside on Google, 1,724. See, down another 20%. So you could easily have the market to take another leg down 10% when you have these mammoth stocks coming in to just support. And so I think, I think with the economy slowing, I think it's just a matter of time before Google comes down to the 50-month. Netflix did. There's Netflix. It came down to the 50-month, consolidated for a month, then it got trashed because they lowered their numbers and they really missed their guidance badly. So this is the debacle that can take place when you break that 10 months. So keep that in mind. Nvidia, see, they come and get, they always get, they always come and get the big winners of the market cycle. And these were the biggest winners of the market cycle. So hit the 10, broke the 10-month. Where's the next support on Nvidia? It is 118. So it's hard to believe that stock could go to 118, but it certainly can do that, particularly if the economy slows down, economy contracts more, we're in a recession. Now, it doesn't mean that every stock will go down. And so what I really see is I see a period where most stocks have gotten crushed, and you have many stocks that have put into the lows. We just need time for the setups to happen and for bases to form while you have a rotation out of Amazon and Apple and Google and Netflix, and those big stocks. So that's what's going to make it so problematic for most people, is that you're going to be wanting to buy the LNTHs of the world. You want to be buying those that are holding up, on a market pullback. You don't want to be buying the QQQ. And, after being up 14 straight years, I think you've got a well-deserved rest. And this is, this, I believe now, is going to lag for a number of years.
Matt, what about Facebook 200-week?
Looks horrible. So, it's broken. It was a big winner, and then it broke. Guys, what I want you, and this is really important. Let me see if I can pull this note up real fast. And let me see. Well, I can just from memory. So you see the way these stocks look. So look at the market top in 2000. So Cisco, when it peaked at the 2000 top, in 22 years, it hasn't made a new high. Now, Cisco was the best performing stock of the decade in the 90s, just like Apple is now. But once it topped and the growth, and it was a mammoth, when it gets so large, it can't continue to grow at the same rate. And that's what happened. So you don't want to get stuck in something for 20 years like Cisco. Look at Microsoft at the top. Microsoft was one of those huge winners of the decade in the 90s, as well as 91, they came out with DOS. They came out with DOS earlier. 91, they came out with Windows. That was one of the stocks that I bought coming out of on January 17th, 1991. But look at the point. Once the market put in that top, it took 17 years to get even. And, a number of these stocks did that from that 2000 top. There's Amgen, which was a big winner. So, don't think I'm crazy when I say that Apple potentially could have made a meaningful top, 4 or 5 months ago. It looks like it's still in this nice uptrend. but it certainly won't if it, if the stock breaks and goes to the 50-month, then the stocks can look at, much different. It's going to be hard for a big company like Apple to reinvent themselves and, with new products. Maybe they're working on self-driving cars. Maybe I have no idea how they'll continue to grow, but growth is slowing right now for them.
So this is my thinking regarding FANG stocks. Since a lot of the folks have started trading in last 10, 20 years, probably not 20, but more so of them have started in 2010 onwards. So they really haven't seen a bear market, and they're in love with Apples and Googles and NVDA and all these stocks. And we are really just starting. We are not even in a recession yet officially. I believe your S&P 5 has just broken that 20%, and we're like 21 or 22% somewhere right there. And we are going to see a bunch of rallies from these points. So most of the people are still going to buy these FANG stocks, buy the dip kind of mentality. And then we are going to go through the recession, which is actually going to happen probably by end of this year and moving into the next year. That is when these FANG stocks are going to break down. And now you're going to hold the back for the next couple of years, which is what exactly happened for Cisco when it broke down in 2000.
Yeah. I agree totally. I agree totally. So it's going to take some nifty maneuvering to take the needle out, if you will. People have been addicted to this like heroin for 20 years. And we're going to do this. We're going to have this rotation. You're going to have this rotation that's going to take place where technology isn't as important. I mean, these big, large technology stocks don't have the impact in terms of performance. They become less of the S&P, over time. I mean, I think there's a big chance that these mammoths, the mammoth stocks that everybody's crowded in, all these stocks are in the large cap growth. They own the same things, all the large cap growth managers, and you've got hundreds of funds out there. They own the same, they own the same stocks.
Also remember that all these stocks, especially the FANG stocks, they have had a great run for 10 years because their products were selling. Once we are in a recession, do you think people are going to buy $1,000 iPhone on an interest for a 24-month plan? That's not going to happen.
No.
Right? So essentially, the earnings are going to go down, and the stock will be repriced at a lower price point. So, and we are not there yet. I mean, recession, officially, we are not in the recession. So I think that a lot of folks who are going to buy the dip, they're going to hold the back.
Yeah. So, I mean, I'm prepared to short the rip on these technology stocks. If we buy the big ones, if they rally from here, I'm looking, and I haven't played the short side, and I'm planning on playing the short for my clients anyway. I'm planning on playing the short side. If we get a bounce, an oversold bounce, in the market back up to the, 50-day or the 200-day. Tesla is a perfect example of a stock that it's showing you some distribution, and it's showing you topping action, and that 50-month. This for me is this is my top idea, shorting Tesla, and I actually shorted it right here and got kicked out. 1, 2, 3, 4, 5 when it bounced up on an analyst upgrade where some knucklehead raised the price target and came out with numbers that they're not going to hit, and they sold right into it. And I actually got stopped out right there. But this actually reminds me of crypto. Look at these. The base here. Where remember when Bitcoin held 30,000, and then it broke through support, and the 50-month on Tesla is 400. So look, if it goes to 400, look, it's still up 10-fold in 3 years. So this is I think that this is, I think that, I think the number, they're not going to hit the numbers. And I think that if the consumer pulls in their horns, then, they're not going to spend $100,000 on an electric vehicle as much, as they were flush earlier. And I think that, interest rates are going to complicate matters. The consumer's going to slow down. And, they've already said they've got to, if you saw the memo that was leaked yesterday, Musk was encouraging his employees because they were having a bad quarter. That memo leaked. And there's your downside. The downside's 400. So
Roy,
yeah,
there's another aspect here. Is
Go ahead,
that
Larry.
Tesla just has that amazing PE that's going to play into supporting your thesis.
yeah, I agree. So,
Totally.
the stocks that have more, downside, or the stocks that don't have earnings that are high price to sales. This happens to have a high PE and a high price to sales. They just announced a 3-for-1 split again. So this is the second split. Many times stocks split when you have. I can't tell you. I can't tell you of a stock that I've seen that's had 2 splits in a year in 10 years. So this is going to be their second split.
I heard that, and that sounded like desperation to me.
Exactly. So, I mean, look how Amazon performed. Look, Amazon. There's the split day right there at 128. So everybody that's holding it because of the split, it's down 25% in a week. And that's after the split. So, many times splits are opportunity. And Apple did this back in October a year ago. There were you had the Apple split with the Tesla split the same day.
Yeah. That was a pretty decent top, I remember.
Yeah, that was a sell signal for sure on the overall market.
So historically, anytime when there is a split on a stock, usually for next couple of weeks, the stock kind of goes either sideways or goes down before it goes up.
Yeah, and remember, just like when you have a stock that's added to the average, to the indexes, they typically underperform as well. That's because that's again a false sense of really organic buying pressure.
Yeah, and it runs up in anticipation of that event.
Yes. Yeah. Many times that's a sell event, sell the event. So notice here in oil and gas, see, you've got potentially you've got red on these oil and gas stocks that are down. You've got the USO you've got the USO that just peaked today. So, and the big ones clearly are Oxy. Warren Buffett owns Oxy, got a lot of publicity, but look at where the stock peaked, 2 weeks ago at 74, now it's 62. And, it is it's at the 50-day, but, to me, that's, there's a good chance that we could have just peaked in energy.
Yeah, especially with Biden heading out to Saudi Arabia, they may cut a deal, and that may affect things.
Anything can happen. I don't know what the catalyst might be, but just institutions start selling. Look at the selling here that's been going on in ConocoPhillips. Look at that big selling, right up here at the top. So remember, this has been the top performing group, and this is how the averages can come down another 10% fast. I mean, if you take the air out like natural gas today, these all come down 10% in a week, and then you hit that 3,400 target, in the S&P, and potentially 3,200, and it happened. It happens fast, when you put in these market bottoms, but we're full of these oil and gas stocks. When you start seeing other companies, and watch this for stocks that start to move up in the industry groups, that's how you know that new leadership is out there. And now we don't have any of that. You know, I was looking at shorting the fertilizer CF coming in, you know, with peak earnings. See, there's peak earnings on potentially the fertilizers. I understand they've got a glut in Brazil where you've got potash sitting on all the decks because they have sitting on the in the port because they've got too much of it. It's just an interesting dilemma, the way the markets work. When you have things like wheat, that's 20%, you know, this is the wheat ETF. When you've heard, you know, when all we've heard about is the shortage because Ukraine provides 40% of the wheat in Eastern Europe. But why is wheat actually down? I can't explain that.
Could be,
yeah,
Well,
go ahead.
I was just gonna say both that and oil, both those prices could be affected if there's some peace in the Ukraine-Russia war.
Yeah, maybe, you know, maybe that's the market. These stocks are like right now, they're telling you that, you know, there's going to be a ceasefire. There's going to be, you know, there's going to be an agreement. There's going to be, you know, right here. Certainly it's hurt both economies. It's certainly devastating Russia. You know, so maybe that is, the stocks do tell you that, you know, ahead of time.
Roy,
Yeah, go ahead.
I know why wheat went down.
Why wheat what?
I know why wheat went down,
Fill us in.
because I bought it last month.
Oh,
yeah.
okay. Yeah.
Share.
Are you almost ready? Yes. Okay, I'm gonna say goodnight and then go pee. Oh,
Well, that's good to know. Where's wheat here? Where's wheat? Oh,
okay.
let me see here. So there's wheat. I mean, you know, there it is. I mean, I think this is when the invasion took place. Then you had a double top. I mean, we're way off the high, and that's what happens when you have, you know, the market moves up in anticipation of this, and then there's no follow through. Look at if you just look at a number of these. Give me a second. If you look at a number of these futures, look at lumber. Lumber peaked up here at 1,600 all the way to 500, came back, and look what's happened. That's telling you that the demand for homes, that's what's going on with the demand for homes right now. Look at what's happened the last two to 3 months. I mean, this is a huge move. You're down 50% in a couple of months in a huge commodity. So, you know, that's telling you right there ahead of time, the Fed's raising, you know, they're going to raise interest rates. There's not going to be as much demand for homes and housing. That's what's going on there. So this is, you know, it's a big puzzle that we're trying to, you know, solve. But, you know, when you look across the commodity phase, I mean, everything is down. I mean, every commodity out there has peaked except energy.
So, but isn't that a good thing though for stocks?
It's a good thing for inflation, you know, so it's a, you know, the Fed's called, you know, the Fed must raise interest rates because of they've lost credibility and they're so behind the curve. So really, if they got ahead of this, you know, last year, they wouldn't have to raise this, you know, they wouldn't have to raise like this, but they couldn't They couldn't tamper enthusiasm. This is good for inflation at the back half of the year. See, inflation, you know, all of our models indicate that inflation is going to come down at the second half of the year, but that's no, it's got to, that's no mystery, because the Fed is going to create demand destruction. They're creating wealth destruction in the stock market. Even wealthy people are pulling in their horns and stopping, you know, they're slowing down their spending now. So you can imagine what middle-class America is doing. So the Fed, what's going to happen, and what is happening right now, is if we're not in a recession, where I think we are right now because of the numbers, it may not be, the Bureau of Labor Statistics may not say it, but if we have those two negative GDPs, we will. But you know, this, you know, the idea that mortgage rates have gone from 3% to 6.125% in 90 days, or that's staggering. And you know, in demand destruction, the energy prices are going to, you know, create demand destruction in driving. So I think I saw where the average household in America, their fuel bill has increased to $6,000 a month. Excuse me, $6,000 a year extra. That's a lot of disposable income. So this is good. We're going. The Fed's putting us in a recession, and rates have to rise as they do that, as they steepen the yield curve. And it's going to be temporary, and they're going to put us in a recession, and then they're going to ease, or the market's rates are going to come down because we're in a recession in the second half, the early part of 2023. That is what's going to happen from a cyclical standpoint. Trying to get all that timing right, that's what makes it difficult. But that is the narrative. That is what's going to happen. We've never had an increase of over 5% inflation and not had a hard landing, you know, in a deep recession. We are going to have, you know, a pretty heated recession where companies are going to miss their numbers, lower their numbers, just the way Walmart, and let me change my screen. I mean, you have many companies. There's Walmart that missed. There's Target that missed. You're going to have, I mean, you're going to have many, many, many companies this quarter that are going to lower their numbers. So, you know, they're going to lower their numbers because inventories are building, and they can't pass on the inventory to their customers. And you know, you don't have as many, you know, people bought all those goods and big you know, appliances, big purchases while we were, you know, staying at home. And now, you know, if they're spending money, it's for more, you know, for services, not for goods. I just got stopped out of this stock as well, Eli Lilly, which great, you know, company that's got, you know, blue chip company that's got a huge obesity drug that is going to be a barn burner. And you know, this is a stock, the blue chip stock, that's holding up really well, 95 relative strength. They don't have the, you know, they don't have the 20% earnings growth, but they've, you know, looking forward, but they've got some blockbuster drugs in the pipeline. And this is the kind of stock that you should be looking at. When you just stay on top, guys, stay on top of looking at these companies, because look at this. This looked like, you know, it looked horrible. and then something happened, and you had this stock made a major move. This is a new drug that they got approval for, and then something happened that generated it right to the top, made a 52-week high. This is how fast the leaders can show themselves right now. But that's what you want to be looking at. You want to be looking at stocks, that go up on volume, that have, something new, new novel technology, new product, something new, and that's going to lead to, the bottom line. That's what institutions are looking for. There's not a lot of those. But if you screen the new high list, those will, this is where potential new leaders can come. The stocks that have relative strength, of over 85. See, I think you've got peak, there's still, see, a lot of these commodities that looked good 2 months ago. I mean, look, these stocks were breaking out to new highs, and then they just totally rolled over. So they had, look, these are peak numbers on steel. See, that's the danger in buying these oil stocks. Like, what if all these oil stocks are like steel was right in here, right at the top? They just came in, they're coming into the 21-day moving average. They look perfectly fine, and then they roll over. So that is, that would be good if energy stocks do that. But, if you're long them, be careful and be sure and put your stop in, because that's what can happen. You can have a great stock that turns, on you. There's NUE, Newport Steel. Look at the numbers. See that these stocks, they're cyclical. And this is why a lot of growth investors don't buy them, because they're boom and bust. They don't have secular numbers. They last for, a period of time, and then they boom bust, and then they collapse. But I think that's telling you you've got peak pricing in steel. FCX. You got peak pricing in copper. That's what that chart's telling you.
Roy, how do you know it's a peak pricing or peak earnings?
You won't know until later. But you'll find that out later. When Carvana reported their last quarter, look, earnings were up 142%. That was peak earnings, and the stock peaked into it. You didn't know that was peak earnings until till later, when the stock went, when it went from a stage 3 to stage 4 downtrend. But you won't know. When I'm talking about peak earnings, the technicals will show you before the fundamentals reveal it to you.
Okay, thank you.
Wes, do you have anything to add on that regarding peak numbers?
Yeah, just that. I mean, I think there's good institutional research and data out there, third-party data that they all subscribe to, that gives them a hint ahead of time, that it is going to be peak numbers. I think Carvana, the thing that mattered to them was used car pricing. I think to be able to make a margin, as used cars pricing was rising, they could buy them and then sell them for higher, right? But as it's falling, that's going to be an issue, I think, for them. And everyone that when I was in research at Wolf with trucking, the only thing that mattered to trucking stocks was spot pricing. So they have daily pricing that's published, or weekly pricing that's published on third-party sites that you can pay for. And so as that falls, or as that peaks, you really kind of are guessing the peak, but you understand the dynamics, like of how it happens. Like we knew that everyone's inventories were were going to be overbuilt just based on our conversations with everyone. So anyways, the point is, you kind of do hint, like you do get plenty of hints from different data sources when you're really, really focused in there to to let you know that the peak earnings are in, and it's nothing's new about it, all this stuff. So trucking's still a good contender. They certainly have had peak earnings. And then like we talked, you mentioned the shippers, really good chance. I mean, shipping has never been a good industry. This has never been seen. The amount of profits that they've had, which is outrageous. But I mean, I'm sure that when you see these things breaking, people understand the dynamics of the industry, and Zim isn't going to go from making $40 to 14. They might go from $40 to $1. They might lose money. It's always been a horrible industry to be in, because it's asset heavy and people are subsidized, and it's never been a good money making industry. So I don't know. I like the idea of a shipper short too. I like to get a bounce in that, which is funny because I was willing to buy it. I tried buying it personally. This Zim too, on that downtrend break, and then just immediately got kicked out, which is fine because knowing the fundamentals, but clearly the institutions are ready to unload.
Yeah, so
Hey, Roy,
yes.
and also just wanted to point out, like, because you're talking about the peak earnings, the technicals will always get you out in time. You could pull up, Zoom video. I don't even think the earnings peak before it started rolling over. You just get out. You know what I mean?
Yeah.
So, you get in through the fundamentals and the technicals, but on the sell side, technicals will always get you out before the fundamentals.
Right. Because that's the thing too. It's like you don't know if Zim could I don't know if Zim could do another $40 a year, and then all of a sudden the stock works for another 6 months. Right.
Yeah.
But I guess it doesn't matter, right? You just got to get out when you see people running for the exit.
Yeah, for sure.
No, guys, let me point this out. And someone mentioned the IPOs, earlier. So in bear markets, particularly the IPO market, there's a character the way IPOs work, particularly when they come out, then they undercut their low, then they build a base. But a number of these IPOs that have numbers that are broken, they just need to go. They need to build stage 2 bases. You don't want to buy these stocks that are down. You don't want to buy the stocks like this. There's Twilio, that's in a stage 4 decline, that's not going to make money this year, and the price to sales is outrageous. Let me see. Somebody wrote on my screen. Let me take this off. And let me pull up that again on MarketSmith.
I think someone drew on the actual Zoom things. I'm not sure how. I think you might have to like reshare or something, like unshare and reshare the screen.
Okay, yeah, let me do that. Stop share. And then share screen. I need to pull MarketSmith up again. Open charts. Yeah, that did it. So like Wes and I are making a list. Now this is a little bit unorthodox, but this is what
we can't see it, by the way. We can see
okay, good.
The web browser.
Stop share. Okay, here you go. Okay, keep this in mind. So these stocks that were in uptrends that are making money, that have gotten hammered, that have bottomed, and see, this is bottoming action. See, this is up 33% off the bottom above the 200 days. So that qualifies of it being in a new stage 2 uptrend after being in this. It's really gone from a stage 4 all the way down here. You kind of a stage one down here, and it's just going into stage two. But what I want to point out is that this is a company that's got earnings and revenue growth. And the estimates this year are 94%, and this year, 77% next year. And it's gotten hammered. So watch this, and you see I have a line here. See this stock, if this stock trades above 51.48, 51.50, it's going to be in a decided stage two uptrend. And it's got poor relative strength, but you can see it trying to bottom. So there are a number of stocks. I believe the lows in, you're not going to see $30 again on this stock. So there are a number of these that look that way, that were IPOs, that when you're looking around, and we're looking for everything, we're running screens on everything, trying to find, potential new leaders. See where there's where the stock goes into a new uptrend, where if it takes out that 1737, see earnings are also out of the way. This is the company that makes the conditioner that's very expensive, that many young women use. That they signed a deal with Ulta, so their products are being the products are on Ulta's in Ulta stores. But notice the revenue and earnings growth. See, look, 44% earnings growth, 58%. These are growth numbers. These are slim numbers. Earnings are going to be up 34% this year, 22. It's all about price. See, it's all about valuation. And now this stock, this is how great IPOs, this is what they look like after they're broken. You just need time. It just needs to put in time. But this is where those, this is where those new leaders can come from. See, this stock can go from 15 to 30 and then 30 to 60. And then, the stock's up a couple 100%. So keep your eyes peeled. And there's a whole list of these, but, Global Foundries, look at the numbers, 37% revenue growth, 74% revenue growth, earnings growth. See, so watch for stocks that were big, that had, a lot of fanfare, that may be putting in bottoms that actually have profitable numbers. See, there's a whole group. Here's, this is a company that develops apps on mobile devices, and the people that develop the apps get paid. But look how it reported the last quarter. Look at the earnings and the revenue growth. They traded 15.9 million shares. The stock was up 34% that day on 600% volume. Remember, I'm always looking for those that have 10-300, because those, in many cases, there's the signature that tells you, game on, right there. So that just happened a month ago. And look at the move. See, you want to look at the movement to see after they reported. You had a huge move. The stock went up 70% in 2 days. And then the markets brought it back down. And look at the earnings growth over here on the left-hand side. Earnings are going to be up 270% this year, 280% next year. See, when you can't, none of these are on the screens of relative strength. It doesn't show up on any of the IBD screens because the relative strength is so poor. But you don't have to get the first 10 to 20% of this. If you take out that number, you take out that resistance area, then, the stocks can be in a clear uptrend. So that's what you want to watch for. See, when the market's making a new low, but you want to see a bottoming action. And here, if you're, but you want to buy the stocks that are making money, not the ones that aren't making money. That's a big, that's a big difference.
Roy,
yeah,
hold
go
on
ahead.
a second. That's the key point right there. Is that going to be what the major shift is going to be once this market turns around is to still continue to buy the companies that make money. In other words, your growth stocks, but in essence, they're still value stocks.
Yeah, I think now it's all about free cash flow, Larry, and making money. And the idea at valuation, we don't know who the winners are going to be, but there are going to be some of these IPOs that were hot. See, there's a reason that they were hot, that people were enamored with them. Most of these have good products. It was all valuation, though. They brought them public at the end of of a bull market, and they're not making money, and so valuations didn't matter. Now they matter, but it's going to take time. See, for companies, it's going to take time, and you're going to have companies that exceed earnings estimates, where the estimates have already been lowered, and then you see a big break. You see those 10-300 days. That's what you want to look for. But if they're not making money, this makes it more problematic. Look at that Roblox that's losing money this year, next year. So price is the most important thing that matters. But if you want to check all the boxes, and if you want to check all the boxes, don't take a big concentrated position in companies that aren't making money, thinking that they're bottoming like this, when they're not making money. But some of these are going to work the way TTD and Shopify did at the bottom. See, I'm not, well, actually, here's Shopify that earnings are going to be up 105% next year. So look at this relative strength. It's 4. So 96% of all stocks in the exchange are outperforming it. You're in this clear stage 4 downtrend. But if you put in the bottom and hold, and then you break over your averages and you go to stage 2, a stage 2 uptrend, this is where some of the next winners can come from, because they're so oversold. But it's all about earnings. So earnings next year, they're going to do $1.05. So the markets can discount that. Then they're going to have the earnings going to be up 100%. That's what will drive the stock higher. And you have so many of these.
Yeah, but Roy, is so much of that pricing based on what it was in 2020 and 2021? Is that still built into this? Just as all the people that are still holding the shares who haven't sold it?
Yeah, I think you've got to be, I think you've got to be careful. You don't know where this, look at this on the monthly. That doesn't look like it's stabilized, does it?
No, not at all.
Not at all. So that's why, look at the weekly, look at the monthly, but they're going, a number of these are going to be putting in bottoms, and they're going to hold. And but you don't want to buy the expensive ones. Like there's Snowflake, which there's the monthly. Look, this has gone down for like 9 straight months.
And everybody still loves it.
And and market cap of 35 billion, and they're only doing $1 billion in sales. This is the kind of, from a price to sales, this stock can get cut in half from here because it's so expensive.
Roy, what's your opinion on DoorDash?
I like the company quite a bit, but it looks like a lot of these other IPOs, it just needs to build a base, and they need to differentiate their brand, and they've got good revenue growth, but they're not, it needs time. They're going to have to turn profitable. So, I think they're dominant in what they do. I like the company quite a bit and what they're doing in terms of transforming the consumer, in terms of providing delivery, not just food, but just like Google wanted to digitalize and store every written word that's ever been written, these guys want to change the delivery to be a delivery company for every mom and pop store in the neighborhood to, you know, big stores as well. You know, they're going to master delivery. And so that's going to be, you know, that's going to be big, particularly, you know, with people that want, you know, instantaneous delivery that day, delivery in the hour and things like that. This is a big market. They just need to turn profitable, but they're, you know, what they're doing right here is it's bottoming. They're getting rid of all the excess. So I'm very interested in this stock, you know, if it'll turn and break out break out of this base here. Again, the stock action is going to tell you. So I would never buy it in this stage 4 decline, but now you can see that's how now it's in a stage 1 sideways market, and that just needs time, or, you know, or an earnings report, or, you know, a new relationship, something new that gets the stock going, you know, some type of catalyst.
So Roy, basically you're keeping all these IPOs on your watch list. And I mean, kind of what I would do is, you know, keep on my watch list and then watch for that 10% biggest volume ever move, because that means the story's changed on the stock or on the IPO. And that's the time you want to either get in or at least have it on your radar for an entry point, correct?
Yeah. And I mean, I'm pretty agnostic, but I mean, this is a stock. I mean, I know how these stocks bottom after doing this so long, but this stock, you know, GitLab, that's gotten trashed. How much is that down from the top? It's down 67%. So it was down like another 15. It was down 85%. So, you know, these stocks can go, you know, these stocks could go under. So you have to be careful. You have to let the market tell you. But notice this is what I'm watching for. There's volume on the earnings report.
You know what's funny? This was the last stock I tried before I threw in the towel and said I'm done. I bought it like when it went that volume, and then when it reversed, I got out. I said I'm done with this market.
So you saw it right there as well, Joseph?
Exactly. Yep. And I used the whole number. I think it was either 50 or 55,
yeah.
One of those numbers. And I said if it gets, and I had a gain on it. It went up like, I had like an 8% gain and it reversed. And
yeah,
I think I got out up 1%. I said this market's toast. I'm done.
It is. So that is exactly. I mean, that's what you know. I'm experiencing the same thing, and you know, dipping my toe in, doing. That's exactly happening. When the market changes, then this is going to follow through. See now, you know, you're putting in the low, turning up. See, you know, breaking above the. That's the. I think. Let me see, what is that, the 50-day technical?
Yeah, 50 day, yes.
50 day. So it's, you know, breaking above the 50 is, you know, again, you could try it again right here, but, you know, you're sort of worn out, you know, and you don't, you know, you can't go, you know, you can't get in front of the Fed or anything like that.
Exactly.
But yeah,
you're fighting against the tape.
Yeah, you're fighting the tape. This is a shoe company. Look at the shoe company. This is the Roger Federer, and apparently these are hot. Larry's probably got a bunch of pairs of these.
Not Roger Federer. He's pretty much going to be done, I would think, before too long, given his age and everything else.
Well, he's going to be selling shoes from now on. He's going to be a shoe salesman.
A shoe salesman. Yeah.
So, but you know, there's the action. See guys, see this, see the nuance here. There's the trigger. There's the earnings report. This, you know, the stock was up big on the earnings report. That's institutional buying right there. But see, see the trend, you know, see where I have the resistance. I have an alert there. That's when the trend changes. So it's going to happen so fast. And, you know, I don't know who these companies are, who they're going to be, but these are the types of setups And I'm telling you, these things are going to go up. You know, these things are going to go up 2 and 3 and 4-fold. You know, if you, with the market, if, you know, when the market will turn, just like on the IPO in 2020,
Hmm.
2020.
Here's just a crazy thought, because I'm not as disciplined as you guys are. All these stocks that you're talking about, they all have to go like 20 to 30 to 40% up to meet your buy points.
Yeah.
Now,
Yeah.
if you're that confident, and hey, we're going to have another swoosh down, and then we're going to come back, and these companies are real companies, isn't that kind of a risk reward that might be worth taking a shot at? Let's say one of these companies, like the shoe company that you're just talking about.
I think
that might be worth
yeah,
it.
Larry, I think it is, Larry. I mean, you know, if you take, you know, if you want to, if you position size occasionally. I mean, remember, you know, I'm trying to have 5 to 10% in it, but you know, but I would put like, you know, I'd put, you know, 25, 50 basis points on a few of these and keep them on my screen and watch, and then you'll find out what works. See, this is a, you know, I want to point out this was a big winner, and this is CrowdStrike, of course, the computer net security company. But notice, and this is the 2020 bottom, but it was a hot IPO that peaked, the market peaked, and then this stock finally put in its base, started to turn up, and then the pandemic hit. And, you know, there's no explanation except just panic selling, and the stock dropped 50% in 5 or 6 days. And that was the low. But notice how fast you're going to see. What's going to happen from a market bottom is you're going to have stocks that look horrible, but they're going to immediately, when the market turns, see, look, it went from 30 to 60 in a month. So you're going to see, and that's what I'm saying, is that I guarantee you, you know, there are going to be a number of these stocks that do that. And look at the bottom. You know, so I am watching down here at the bottom. I'm very aware. Look at that 14 million shares traded at the bottom right there. So you see that signature where you have the explosion in volume. And for any of these, so it doesn't matter if it's Olaplex or Onion or whoever it is, you know, if they have the signature that shows you that institutions are buying it, that's the first, that's your go-to. And notice here, you know, stock went from 30 to 100, you know, a triple, you know, and the market was just getting going. And,
Quick question
you know,
on that.
Huh?
This in general. Okay. First of all, you called it Onion. Is that what we're calling ONON now?
Yeah. Uh-huh.
Right. Just want to make sure. So
Yeah.
what are you saying is the buy point on ONON? You know, I think I wasn't sure if Larry, if you were thinking that you'd want to buy it, you know, hitting an all-time high or at $40 maybe, you know, because that's a clear kind of resistance line. Is it, or if, you know, are you buying it, taking out that first lower pivot that you have marked there at $24, $23?
Are you asking me or are you asking Larry?
Well, I'm asking you because I'm not sure if Larry was kind of pointing out that
Larry from a
point would be a new high, but that's obviously
yeah.
What are you saying? I'm was distracted for a moment.
Yeah.
Oh, okay.
So Larry, you could buy this stock. You could buy this stock right here from a trading perspective. You could buy the stock right here and put a stop right there, 1 bar. And like when I trade, when say it's, and of course everything I do, it's a trade, not an investment. But that's the type of setup exactly that I look for, where you can have a tight stop, and it's 1 bar, so it's not 8%, it's 2%. But you take size on that, you know, you get a big position, but you get kicked out immediately. But from a trading perspective, that happens a lot to you when you're trading. From an investment perspective, the trend won't change until it crosses that resistance. So there's your true, this is like cheating. This is getting in early. But you know, you could get whipsawed, you know, and you could certainly get whipsawed. This is one to definitely watch, for example, to see, well, how does it react when the Fed tightens tomorrow? But that supports 1638. So it could, you know, say this market comes in, it comes unglued. This is what you want to watch to see if it holds this 1638 or down here. It could undercut and then turn back, and that, you know, put in a double bottom, which is a buy, you know, which is a buy trigger. So, you know, so it's, you have multiple setups here. You know, you could buy it at the double bottom, taking out 1638. You could add a little bit, you know, a little bit here if from an investment perspective. You can buy a quarter of 1%, then go a half, then go to 1, and then get a position, you know, in it, and then press it up here at 24. There's a lot of ways to handle it. You just want it to calm down.
Yeah, I see what you're saying. That makes, see, that makes sense to me, because that's, I mean, even in the good times, these are things that I'm kind of watching for.
Yeah.
Right. And like I said to you, you put in the stop as you described, but you don't have to give up. What is that? That looks like a 25% or more gain before you find out that it's actually going to work. So if that thing doubles, you've almost given up a triple.
Well, I mean, your strategy always like to, you know, you like to buy these that are down in the bases like this. And, you know, some of these have turned out to be home runs for you. And, you know, it's come down enough. It's, you know, they're actually doing the numbers, but again, it's in the retail area. So you've got to be careful of retail spending. And these are fancy shoes as well, which can happen there.
Well, that was my next question, is you've identified a lot of companies that have this stock, you know, positioning, for lack of a better word, but a lot of these are going to be, if we're in a recession or in the later stages or an early recovery of the economy, those aren't going to be your hot sellers.
So
you
exactly.
You got to kind of think about the potential future fundamentals in these thoughts.
Yeah. I mean, ideally, you want something that can sell in a recessionary environment, like that LNTH medical imaging agent, you know, it's something new and novel that's going to, that they've all, you know, they doubled their revenues last quarter. So it's not going to matter what the economy does on something like that. You know, they're not
covered by insurance.
Huh?
Covered by insurance.
Yeah. Yeah.
Roy, I saw someone in the comments talking about overhead, about the stocks being up by, and they have overhead supplies, but you know, like once the story changes, like for instance, if you pull up PLAB, PLAB,
yeah,
I mean, that had a 10-300 and there's overhead supply, and in a couple of days, it took all that out. I mean, obviously the market took it down, but it just goes to show you how fast you can get past that overhead supply once the story, for whatever reason, changes.
Yeah. And I mean, notice this wide and loose, how it tried to break out. And this is on my watch list as well. There's earnings where it had that 10-300 to tell you to get in, followed through, came back now to the 21 days. So, you know, they have decent numbers. I mean, great numbers this year, decent numbers next year. You know, you don't have a lot of these stocks that are, you know, that have triple digit numbers, and you've got triple digit, you know, got triple digit earnings. Look at that, the last 3 quarters. You know, William O'Neill in his studies found that some of the biggest winners had 3 consecutive increases in the numbers, in the quarterly numbers before they took off. So look at the last 3 quarters, 181 to 189 to 204, earnings 33, 38, 49. I have a screen that I run similar to that with using 40%, using a 40%. I'll show you the screen in a second, but there's PLAB. See, this is a potential winner, leader, that's bringing it back in with the market. Now it's come in quite a bit. It just needs to build a base, but it's holding at the 21-day. SWIR is another that broke out. See, there's the 10-300 right there on that day.
I was gonna
So
point
it's-
out UTHR too. I feel like it looks identical to
Yeah.
that plaid.
And so it's right here at the 21-day. So this is, so it did have, it had overhead resistance, but some of these have overhead resistance when they go. Let me see the market, March 2020, March 2020. See, notice the overhead resistance on Shopify. That's wrong one. Shopify as I wanted. Okay, look at this Shopify. So there's there's overhead resistance. It's down 50%. Now what did that stop? That came down to the 200-day. So all the way to the 200-day, down 50%. And then, you take a look at this a few months later. 0. Let's just go to, let me go to 10. Look at that. There's the overhead resistance down here. There's the March 2020 bottom, all that overhead resistance. And this, this stock had a huge move. And so, it went up. There's the overhead resistance right here. So it had like a 5-fold move from the bottom. Tesla did the same thing at the March 2020 bottom. So
and Tesla's the perfect study because it came down to this 200-day in the COVID crash. It didn't even get below the 200-day, I think.
There it is right there. I mean, look, it came, it came right to the 200-day. I mean, this is a huge drop, which is down more than 50%, right? Down 50% and overhead resistance, but the numbers were coming through. See, Shopify, the numbers were huge. Tesla, the numbers were huge. And I don't see anybody with huge numbers like that. Not a big, we call them big stocks. So it can take a little while before something happens. Now, the Chinese stocks look like they're bottoming and they have decent numbers. So, here's China. And you really have two stocks to play, and that's JD with 90 relative strength. Look at the relative strength, and look at how the relative strength line is making a new high. Look at the bottom, 38 million shares right there. There's the bottom. You're etching this bottom out. It's already down. It's down a bunch from the 52-week high, which it's only down 30% now. So that was down 50%, 40% or so. But they have, they're going to have great numbers next year. Earnings up 54%. It broke. That's when they said China was uninvestable. Right here, when the stock came unglued, this is when they had the rhetoric about them, auditing their books and so forth. But this is now potentially turning up the way PDD is. Look at the relative strength, 97. See, look at this huge downtrend. Now you've got that stage 1 base. Now it's going to a stage 2 uptrend, getting above the 200-day. And look at the numbers. See, really solid numbers.
And look at all this volume that's coming lately.
Look at that. Look, there's the bottom. Look at that. There's the bottom that's telling you the bottom. It doubled. Now it came back. Recheck the bottom. See, a number of these stocks are going to be doing this. you know, from down here at the bottom, see, you know, you want to see the low end, then you want to see them. See, this has been, you know, 2 months. So I'm definitely looking at this with solid numbers, you know, 24% this year, 38% next year. See, this is a stock that can go from 50 to 100. You know, based on the numbers coming through, maybe we, you know, and I think there's been some rhetoric from Washington about us, you know, having a more moderate tone with China, you know, because it's in our best interest. So keep an eye there. The KWEB is the internet index there that you can buy, KWEB. See, that's bottoming action. So this is the internet index, and you can click on it. You know, you've got Alibaba in here, Baidu, and that's bottoming action. As a group might come back into favor. And the relative strength, look at that, it's 74. You get a little pop here and it's above, you know, 80 with, you know, one more update, 1 or 2 more updates, and the relative strength goes over 80. It starts hitting everybody's screens.
Roy, could you look at BYTDF?
This is certainly the best performing EV, BYDDF. Look at the strength in this thing. Look at the relative strength, blue dot. Relative strength making a new high, blue dot. Look at the numbers by far. You know, this is a, you know, it looks great. Look at the estimates this year, 124% and 63% next year. This is definitely, I mean, this is a leading stock. This can be a potential leading stock in the market. You know, look, this is the move off the low. See the move right here. It's quickly going to new highs. I would definitely think that this stock is a potential leader. I'm gonna write that down, make sure I don't forget.
Is that the one Buffett?
Yeah.
Okay.
Great numbers, great action, but look at it. It only over the last month firmed up. So, you know, watch for that, guys. You're going to see this happen like in the next 30 days. This stuff that looks like, you know, total dog shit, and it's going to like turn, and you're going to get confirmation action. Institutions are going to come in. So definitely watch that.
Hey, Roy,
this looks really good.
Roy, this is the one where there was a news that Tesla is going to buy batteries from them going forward.
Right. That's right. Yep. For sure. Speaking of batteries, I took a whirl at that Albemarle breaking out. You know, they raised their numbers, raised their estimates, and that's just kind of the, you know, the stock. You know, I'm looking for every possible new theme. Like, okay, what can get going? And I bought this stock that day on the breakout, and then it failed the next day. And, you know, just that's kind of, I thought, there's Goldman Sachs downgraded the group, LTHM and Albemarle. But, this stock broke out and then it failed the next day. Look at that. I mean, so going back, there's probably the follow through day, a follow through day. I probably, you got to buy some stuff on the follow through day. There's the buy and going to new highs. And then, immediately, it immediately came in. But that's earnings. Look, there's your 10-300 on earnings. That's, telling you to buy this stock. And look out, and so this is on my watch list again, but look at this, look how wide and loose it is. But earnings are up 500% this year, 20% next year, great numbers. you know, you need you're going to need a lot of lithium for EVs.
I was gonna ask you if you saw any outside of the, well, I guess the Oilers are getting hit now, but outside of the Oilers, do you see any industry groups that could have like a theme or that could lead the next uptrend?
I thought it was the LNG area. So, you know, LNG, you know, it's very expensive. Natural gas is very expensive in Europe. And I thought that, you know, these companies like FLNG who transport it, you know, I thought this could be a theme, you know, breaking out to new highs, telling you that, immediately selling off, getting, you know, crushed. That's just the environment that we're in. And you had, you know, you've got a couple of companies that are in that area. Just stop breaking out, breaking the downtrend line. So none of these themes, Joseph, just none of this. There it is. I mean, there's the theme. There's your buy point, failed. So you got more and more and more of these. They're not ready, or the market's not ready.
Yeah.
You know, maybe you need another earnings report, and it's showing you, and maybe the next earnings report, you know, earnings are going to be reported in July. But I thought that this natural gas theme, LNG theme, I thought that was the theme. I thought lithium would be a theme. You've got two companies. You know, you want to have more than one company, remember, too.
Yeah.
You know, if you get two companies in that, you know, you want two leaders, just like SEDG and ENPH. You know, those are the two leaders in that.
There's another one I tried that it just didn't work. I tried to double bottom buy it, I guess.
I did too.
Yeah.
Yeah. So, I mean, watch it to see. It's on our, you know, the numbers are good. Numbers are good this year, next year, but it failed, broke out, and then failed. See if the second, you know, mouse gets the cheese. You know, do it again. You see if it can build out the right side of the base. SEDG, that ENPH is better. You know, it's got a better, you know, had a better chart. And this is one that Wes and I were looking at adding as well for the fund, and then it just rolled over.
I think if we get some capitulation like those Chinese stocks had, maybe, you know, we can get close to a bottom, but yeah, like look at this. Wow.
I mean, just breakouts all over the place, failing, you know, looking like they're ready to go, and, you know, going to new highs and then failing.
Well, that just matches the market. I mean, the market was looking like that bear market rally gave the illusion that it was the real deal. And
Yeah,
it had
it
enough
did.
of the pros sucked into it to really, you know, at least keep that money flowing in for.
I'll be honest, I'm kicking myself for not buying some SQQ when that trend broke this little consolidation we had on that Thursday.
Yeah, we are too. If we get a rally here, Wes and I, we've talked about it. We get a rally to the 50-day. I mean, we think that, you know, we think that we're going to be in, you know, possibly, if we get a rally to the 50-day, there's a good chance you got a meaningful low end because of the breadth and how extreme things are. But we're planning on shorting up here by buying the SQQQ.
I think that's a sure thing that it's going to break through.
That it's
that we're going to hit our low.
That it's.
That's just my bad sense of humor. Sorry.
Oh, it's. Guys, what any stocks you guys would you like to pull up?
Well, I think we've done a really good job of really laying out what the roadmap looks like and what our game plan is. I think I don't know how meaningful stocks are right now since we're not really doing it. We're just really planning on our next moves, right?
Yeah, yep.
Right.
And that is what I really appreciate about this segment of the meetup is that we got a game plan. It looks like it makes sense. It looks like that the market's starting to at least feel like what a market's supposed to feel like, even if it's a bear market. I mean, we were looking at this market all through this whole pandemic when money was being thrown by the Fed to keep our country going like crazy. So therefore, we had nothing to base anything on.
Yeah.
At least now it starts to begin to seem like we can at least put together a game plan to get back to normalcy.
Yeah, it was so unusual because you had let me see, you had the FANG stocks leading, and while the real market was, you're getting carved up. There's that February top, Larry, from where growth peaked. And there's what happened with this is what was happening under the surface, but it was being hidden because the QE was going into the QQQ.
Yeah, exactly.
In my eyes, the choppy markets are the worst. I'd rather have a confirmed downtrend that we're having right now, or a confirmed uptrend where we can make money for sure. That choppy market was rough.
Yeah, this is brutal. This was incredibly hard. I mean, I know a lot of people that were down, in the year because of this, the up and down, the up and down. We're going to, I think we're going to a phase where you got to be careful, like from 67 to 82, when the market peaked and these various times, like Microsoft and Cisco. You've got to be careful. You want to be in active management because you're going to find there's alpha in that. You're going to find stocks that go up a number of fold while the market goes sideways. And, particularly if you believe my thesis that money's coming out of the technology, the big technology companies, that's going to open the door for many other small and mid-cap technology companies to rise to the top. But you don't want to get trapped. You don't want to get trapped in a NVIDIA or Microsoft or any of those stocks that they might do this while you have leadership from other groups. See, this might be a foretaste of what Apple and NVIDIA and all these are going to do in the next 12 months, just like this. And you're going to have individual stocks that, that lead, that have good, great revenues and great earnings. We're doing the flipperoonie here is what's happening, in my view.
Yeah.
This is a tiny stock, guys. LVLU. It's a retail company. It's too small to buy, for me, but trading's 250,000 shares, but look, it broke to new highs. That's an earnings report. And it's real cheap. Look, they're doing 500 million in revenues. Market cap's 500 million. I mean, this is dirt. And actually this says, if you go to their website, lulus.com, and they've got some terrific, reasonably priced merchandise for primarily women's fashion. Looks like great merchandise. So it broke out to a new high. Market's taking it in. This is, there's, I would definitely watch this stock. This is one that you could buy right now, today, and use a stop at today's low, but supports at 10. So that's 20%. See right there. If the market, if the market comes in, it's going to go to 10. But it broke out to new highs, so it's showing you something. If you get some legs under the market, this could quickly go back to new highs and be a big winner. It's so cheap, a price to sales of 1.
Roy, Can you take a look at EOLS? I know it doesn't look the cleanest. They're like a contender for Botox.
That's a pretty good pattern here. I mean, great relative strength, Dana. You know, look at you know, this is everything that you should look for. There's the earnings report. You know, the stock was up on the earnings and it went higher. And this is the market gyrating here. It just needs to get, you know, its legs underneath it. But I mean, this is you know, an inexpensive stock. I mean, from a price standpoint, but, you know, $650 million market cap. So you can have companies like this that come out, you know, with a good earnings report, the way that LNTH did. So this is, I mean, this is, it's setting up, the pattern is setting up quite interesting. There it is on the weekly.
Oh, it's a younger name. It's not that old, 18.
Yeah, that's so, you know, nobody knows this company. This is where leadership comes from, Dana, in my view. So, you know, you see this stock take out this high, and, you know, particularly on volume. What was the news right here, Dana, right there?
And I don't think it was anything significant. It could have been earnings.
That is where nobody's heard of this stock. That's where leaders come from. Let me see who owns it.
That one only came up on a screen for volume, consistent day over day volume spikes, and price
right
action.
there. You ran your volume right there. Yeah. See, I think that's a great screen. I think that's a great screen. You know, who's up on volume, and certainly you have it keyed so it's consistent. So it showed up higher than normal volume for like 5 days, up volume too. Let me see, one of the screens, 40% sales and earnings growth. This is a pretty good screen. Who's got 40% sales and earnings growth above 15, 50-day average volume 300,000 shares, where the relative strength over the last 3 and 6 months is greater than 70. That is within 25% of its 52-week high. And so there are only 78 names on that screen, you know, so I run a lot of screens to try to find out, you know, find out who a potential leader might be. And see, like, yeah, this Driven Brands, that's a collision stock. That's a collision company that's located here in Charlotte. But, you know, some of these stocks, you know, when you run your screens on MarketSmith, you're going to identify, there's Quanta Services, PWR, the construction company. You got a couple of energy stocks there. There's Merck's in the list.
So, you know, something like this, and then Eli Lilly and Bristol Myers, all those were starting to screen out. Maybe it's pharma that comes in.
Yeah. And I tell you what, it could be coming out of just out of nowhere. It could be biotech too. You know, biotech's underperformed for years, for like 5 years. And so pharma could definitely, I mean, I own the Lilly, and there's Merck setting up great. And, you know, so Merck rolled over, and it's just now it's questionable.
Look at
I still own Lilly, hoping it'll turn around.
And I sold Lilly yesterday.
I haven't hit my stop, and I probably should let it go, but it hasn't hit 7 yet.
Yeah.
a biotech is Dawn, DAWN.
What's the symbol again?
Dawn, DAWN.
Oh yeah. Okay. So that was, yeah. So look at that accumulation. They must have had like an FDA or.
Yeah, they had some drug they got that's working for brain tumors.
Yeah, see something like this, it's, I mean, you could get some leadership. And again, when all is said and done, and if when you're saying, was price the most important thing or earnings, you like both, but price dictates. But, but it's just these stocks, particularly if it's like FDA, just a FDA phase 1, and it's going to be 2 or 3 years before they have a drug. Most of the time, I always pass on stuff like this, but it gets my attention. A cancer drug that just had that signature ACLX.
There was an article yesterday, Rowan, IBD had on it, if you look at the news with it.
Oh, on Dawn or?
Yeah, they did an article yesterday.
Okay. So, I mean, you can get leadership. Yeah, so I'm going to take a look at the article, but, look at this. See, this stock came out of the blue, and apparently it had tremendous efficacy in treating the initial group of patients. Like, I think this was like a Lou Gehrig's disease or some kind of cancer drug, but look at the accumulation. See, look at the mountains of blue. Those are institutions that don't have many ideas. They're piling into something, a pure momentum play. And, the problem is that some of these can flame out, but you can, but that's definitely, this stock made a new high. There's the accumulation. So, this is also a flag pattern there, so a power, a power play, if you will. So, you're going to, just, watch the volume. I run that 10-300 screen, what hit today. There's FedEx, Continental Resource that wanted to be taken private, and Oracle actually was on this list as well, I believe. But there's FedEx, there's the 10-300.
Why do I feel like Gil Morales was shorted right there? I'm just kidding.
Oh yeah, for sure. For sure.
Is RDBX the new meme stock?
Or who?
DBX, red box.
Oh.
RDBX. B as in boy. B as in boy.
Or
RD as in dog, B as in boy. X, yeah.
Yeah, looks like it. I don't see much. I don't use my DVD player too much anymore.
Yeah, that's funnier than GameStop and AMC.
Is it what?
That's funnier than AMC and
GameStop with the red box. Yeah.
Yeah, it's completely what's the word?
Obsolete.
Obsolete. That is
obsolete.
Ridiculous.
Yeah, that was my favorite back in the
I just
day.
wonder who
I loved it too.
Who's buying this? Like what fund, or there's someone moving that stock. I'm like, who the heck is this?
Mm-hmm.
It's the people who are tired of GameStop.
Hey, Roy.
Yes. Hey, Sandy.
Hi. Hey, I'm looking at my economic calendar for the rest of the week.
Yes.
And it looks sad. In the morning, there's retail sales at 8:30 ET time. And then we have the at 10:30 ET time, there's the petroleum status report. And then at 2 o'clock, there's the FOMC announcement, which is that's going to be a huge impact to the market. And then there's the Fed chair press conference at 2:30.
Sandy, let me ask you one thing. Do you believe in drinking during the day?
No.
Because you might need a stiff drink after tomorrow.
I know. The rest of the week is not even better, because Thursday we got the housing report, the jobs report. I mean, and then on Friday, why is Powell speaking on Friday?
I don't know who he's speaking to. We have, what we have.
It's a market down after Wednesday.
Yeah.
Oh, that's why he's speaking.
Gotta reassure the market.
And then Friday's also the quadruple witching.
Yeah,
So-
we've got like $3 trillion worth of options and stocks that are maturing, options of and indexes that are maturing.
on Friday.
Maybe stocks too. Yeah, Friday. And I really don't know. They're talking about this gamma trade. I have no idea what the gamma trade is, but that's circulating on the Wall Street desk right now. And it has to do with stocks. It has to do with stocks, their option premium is expanding, or they're having to cover their options, and their option premiums are expanding, and they're trying to roll it at a faster rate. I don't know exactly what that's going on, but it can create some volatility. Actually, I think one of the last times that happened, the market was down. Nasdaq was down 300 points that day, and then it closed up 300 points.
Wow.
Big swing there.
Sounds like volatility to me.
Yeah.
Yeah, we just got to be careful Wednesday and Thursday for sure.
Yeah, volatility. I mean, again, this is the hardest market I've traded in since 2007, and they're going to show up. I mean, every stock that you're buying, most of them are reversing on you, but you need a foothold when the market turns and it sticks, and you don't know what that's going to be until after the fact. But there's been some false alarms for sure, but there's not. I don't see a lot of stocks with triple digit numbers. Just run the screens. What stocks? What the relative strength lines making a new high? Relative strength, blue dot, and see if you can. It's going to be. I like the way I think Joseph phrased it. There's going to be some themes that are out there. And, there are going to be some themes out there. This has got my attention. WWE, this has got a good chart, great earnings, solid, good numbers. And this is broke the downtrend line. And it's right above the 50-day. This is on my watch list, buy list. But if you bought it the 10-day, you would have been stopped out yesterday. I mean, all of these things are just coming in, 10 to 20% in a day or two, but it's trying to build this base. And this has got an interesting story, opening up the economy and so forth.
You know what I'm curious about, especially after this conversation we had about this rest of this week. So this might be the thing.
Could be.
And that's going back into my Tilray. As crazy as that sounds, I can't believe that it could get lower than 3 in a little bit.
They could do a reverse split. It'll go back to 30.
Yeah, I know, but I'm just saying, I think, this is just me. I kind of have a little different mindset than most folks here, while maintaining a lot of that same discipline.
Yeah, for sure.
So I'm just saying that there's only so low that these pot stocks can go, because people are going to smoke. And I think it has to do with the fact that the expectation is that the Republicans are going to come back in and they're going to squash it all. But
Well, look, guys, this is where we might be. Look, you see how we had a quiet and again, this is what happens. Look what happened. This is the 2018 bottom. You had this blue day. You had this move down, where the market really came in. You had a consolidation pause day, and then we melted. You melted for 4 days. So we really have a perfect storm, where if we would actually do that, this would wipe the slate clean, I believe. And I believe that would be a meaningful bottom. If we get this kind of panic and the VIX spiked, tremendously, put call ratios tremendously, but you had a huge 4-day, that's 1, 2, 3 day where you got smoked. And so tomorrow is Wednesday, Thursday, Friday, and Tuesday. You know, you could have some kind of meaningful move there where, I mean, you see the devastation that's taking place. This is unprecedented. And you get that, you know, you get a move like that, it happens so quickly. And, you know, so, you know, I'm optimistic that, you know, that something like that would happen because it would clear the slate.
Hey, while you're doing that, just to confirm that, can you put up the chart for the VIX and see how that parallels that activity based on, like, let's say, where we are now?
Yeah, I'll pull it up. And look how volatile, look, that 2020 bottom. Look at this, look at the down and ups. I mean, this is 12% moves in a day. Up 12%, down 12%. Look, that right there, you're down 9.43% one day, up 9.35% the next day. That's how, like, that's the volatility right there that suggests, like, I'll pull that up, but that's what the bottom, we got everything except this. We don't have, you know, you get this in 3 or 4 or 5 days. You know, I'll go out on a limb and say, man, that's, you know, this is going to be the bottom of the whole, this is going to be a significant bottom.
And that's good you show that because there could be volatility on the upside too.
What's that?
I was saying that's good that you're showing this chart just to show that, you know, we could get volatility to the downside, but you can also get to the upside, and you got to be careful because you don't want to get caught like buying that huge up day, and then what happens the next day, you get a huge gap down, you know what I mean? Yeah. So you really want to, in my opinion, as a trader, and, you know, I'm a trader, I'm avoiding this volatility, but that's just me.
Yeah, for sure. Market sentiment.
I've turned into a day trader.
Well, that's what this market's been, a day trader market pretty much the past couple of weeks. If you're good at day trading, you've probably been having a good time, but if you try to hold stuff, it's been rough.
Can you guys see, can you follow this chart? Can you see it legibly? Is it legible? Okay, so Larry, I'm going to take out the date. I'm gonna move the date to say, well, I'm gonna go out 15 years.
We still see the Market Smith. I don't know if you're still on Market Smith or not.
I'm not.
Oh, yeah, we still see the Market
Stop.
Smith.
I thought that's what you're meaning. You were going to change it to Market Smith.
No, I'm gonna change it
With
right.
the Nasdaq there. Sorry.
Okay, so here's the S&P, and here's the VIX. Now this is going back. Look, that's what, 10 years or so. The 14, 15 years. So there's the VIX spike there, right there. And, you know, so, I mean, we're at 32. We need to be up here at, well, Ned Davis Research, they're looking at 43 or higher. You know, as you know, when you go back and you look at these meaningful bottoms. So, you know, the VIX just, you know, the market's come down. The VIX, you know, needs to close in, and this happened quickly, like that 2000, there's the 2020 bottom where it lasted, you know, that last 5 days, 5 to 10 days, and you got it. And that was the biggest, that's the biggest that we had, I think, in history, I believe, that VIX move.
Tell me if I'm seeing this wrong, Roy. That uptrend that we're in and the VIX, I don't see that anywhere else on that chart.
The uptrend.
It seems like we've got a different pattern than we've ever had, because I don't see anything that looks like that, at least to my eyes.
It's,
you know, from July to current, nothing else looks like that.
I mean, I think you're right.
Well, also now I feel like nowadays, and correct me if I'm wrong, Roy, there's just a lot more. I read something that the VIX has been, has been elevated the last couple years more than usual, is because there's a lot more option activity. But that's what I read, that why this VIX has kind of been, ever since the COVID crash, it's high. Like, it's not like if you go before 2018, it's super low. It's like, it's kind of just elevated.
Yeah, but Joe, that's not what I'm seeing. I'm
Now, you can see, no,
I'm
take
seeing
a
an
look
up,
at this.
I'm seeing an uptrend. We've never really,
Yeah,
unless
so
the previous chart we had, we never saw like a 6-month uptrend or
you
whatever.
had
like
one
this.
back here in 2018. Look at that with the 50 days above the 200. See, look at that for your uptrend.
It still
See,
doesn't
with
look, to me, it doesn't look the same. It doesn't have
Yeah,
the same-
I mean, this was longer, and maybe this is the beginning. See right here where you had the, you're about, we could be like right in here, and look at from an uptrend. I'm looking at the 50-day over the 200-day, and you're right. It's below it here. There it was very short. There, this was like so fast. Below. Below. Now you're in this. You're clearly seeing where the trend is changing, where the 50 days above the 200, and it was below it, see, for all this period of time,
Right.
for last year. So you're seeing this subtle change there. I know it's sort of difficult to see in this chart.
Yeah, it's a messy chart.
It is messy.
But that's what's that confirms to me what I was saying earlier, that because of that, we may not get the expected result. I think 43 sounds very reasonable, but it may get there differently.
Yeah, I think it's got to get there, though. I think it's got to get there.
Yeah.
I'll be honest, I'm
Yeah,
surprised the VIX wasn't more elevated when we had. I think it was like the downside, maybe on Friday, was like it felt like so many stocks were down compared to up, but
over 90%.
yeah. So I was surprised the VIX didn't get higher that day, honestly.
Well, so did a lot of other people. You're not alone in that view.
How about this? Check this out. So we had a 92-1 down day on Monday. That was yesterday. And we've had 3 consecutive 10-1 down days for the first time. This has only happened 4 times in history. So 4 times in history is a long time. And that's why, I'm getting bullish here because the sentiment's so bad. I mean, you turn on the TV and I know the devastation. I mean, this has been brutal. This has been, brutal. One of the worst markets I've ever seen. And this is what how bottoms are formed. Look at this volume. Look at the volume. That was the volume on yesterday, the day before. So you're having this excessive volume. Now, what you want to see, a big swing in volume. Like you want to see like 5 to 10-fold on a reversal. On that's to cement that a potential low is in. Where you're down big and then you reverse it and you're up big on tremendous volume, where you go from weak hands to strong hands. But you're getting, these are signs, this distribution, this is capitulation that's taking place. But, it might, so this is what's happening in the overall market. It just might not be happening yet with the indexes. But I think, again, the apples, they're coming down. And, I think that's going to be the art, is finding the new leaders while you ditch, the cues. I think, I think the smart thing to do is to buy I think now to buy the Russell 2000 or buy the Spider, let's say the market crashes in the next 5 days. I'm not going to buy the Qs. I'm going to buy the S&P 500, and then you buy the smaller cap companies. If that would happen, if we would get, if we're down 10% and 10 to 15% in 5 days.
Um, and this is changing your whole trading philosophy. It sounds
Well,
like for the next
it's
leg.
just it's just reaching for what you think is the highest probability. The money's going to be made in individual stocks. I just don't know who they are yet, Larry.
Yeah, I know, but we're trying to,
I feel like when
you kind of put a profile to those stocks, like in that segment, like 10, 15 minutes ago.
Yeah,
I've been doing my technicals, and there's a lot of news that's impacting my technicals. So you just can't go directly on your technicals in this market. You lose all your money. It's so much.
Yeah, I mean, it comes down to that. I mean, at the end of the day, the S&P and the Nasdaq, I mean, especially the Nasdaq, I mean, it looks like a stage 4 downtrend. So, at the end of the day, we're just fighting against the tape right now. So it's just hard to make money.
You gotta wait until the next blowdown.
Yeah. I mean, there'll come a time where, you'll see so many stocks that are setting up that you won't even be able to buy them all. You'll have more than you can count on both your hands. You just gotta have, progressive exposure and finance your risk and stuff like that when the time comes.
So what do you say the trend is?
We're in a downtrend right now. We're in an obvious downtrend.
No, I'm talking, I know we're in a downtrend. I mean, like for the next week.
It remains to be seen. So that's going to be interesting to see. I don't, there was someone asked me, what do I think is going to happen, tomorrow if they raise 75 basis points? I have no idea. I don't know if, I don't know if the Fed is, if the more it's, if they're trying to reacquire, continuity in terms of their leadership. Yeah.
Yeah, they pretty much lost control of the Fed. I feel like it's just
So
they're in a losing situation.
The market action is going to tell you. The market action is going to tell you, but the leading stocks, they may show up. The stuff that's going to bounce the first are the indexes, because that's where the institutions are doing. But you're going to have. I mentioned a few of these like LNTH and CLH. I mean, some of those, if we get a big reversal, watch to see what's up the most. What's up on volume. And those are the things, that's where stuff that's negative that goes positive, if it turns during the day, on a big down day and then it turns green, watch to see where the money's going. And some of these institutional, some of the stocks that we talked about tonight, if they're up 10%, if they're up 10% and the market's up, 3 or 4%, keep your eyes peeled. It's very important to run as many screens as you can right now to try to find that leadership. This is definitely not the time to take a vacation. It may be the time to not do anything and sit on your hands, as that last follow-through day has failed. But, remember a follow-through day, this was, okay, we were up today on the NASDAQ. So this is day one of an attempted rally. So the earliest that a follow-through day can happen would be Tuesday, Wednesday, Thursday, day one, Wednesday, Thursday, 1, 2. It could be Friday. Today's Tuesday, Wednesday, Thursday. Yeah, it could be Friday. Would be day 4 of attempted rally. The window's open on Friday. And, so.
You mean this Friday?
Yeah, day 4 of a potential, follow through day. You start counting the first time that you have an up day after the market's in a correction, and we're in a, market by definition is in the correction right now. But remember, the last follow-through days, we had a follow-through day there and there. It failed. So we took out the low right there, and then you took out the low of the follow-through day the second day right there. So it failed. So that's when the Fed, the last time the Fed met right there, you know, was up huge, and then you gave it all back the second day. So, you know, there's your follow-through day on the Nasdaq there that failed. There's another follow-through day that failed.
And pretty much if we even rally to like the 50-day, let's say, if
Yeah.
there's still, if I still don't see any setups, I ain't gonna buy anything.
Yeah.
Like it could be a rally through Apple, like, you know, the mega cap
Yeah.
tech.
Yeah.
I won't buy nothing. Or we could go sideways, but if I see these new IPOs and, you know, leaders starting to come up the right side, you know, maybe I'll give it a shot at something. You know what I mean? It just depends how the individual stocks act.
Right. This is, you know, this is, I mean, this is what happens at market bottoms. You know, you don't know what stocks are going to work, and, you know, you don't have the leadership, but then you know, so, I mean, we could go sideways right here. If we just go sideways and you see some of these stocks that we talked about earlier, build bases and consolidate, that's really what you want to see. You know, so the market can stay right here. We're down enough. We're down 34% on the Nasdaq. We are down enough. You've got, you know, the most bearish readings and sentiment and breadth that we've had in 5 years. So you're checking a lot of boxes. We just don't have that last final capitulation. Like you get 3 more days like that, and then you're going to have fear, and people are going to be panicking. That's going to mark the bottom. If that happens, you know, like that, and again, those levels to look at, it's 98.50 to 10,600. Those are the lows to look for. That's where obvious support's going to be, and it's 3,400 and 3,200, 3,450 to 3,200 on the S&P 500. Look, so, you know, if we get 3 more days like that, you're hitting everything that we've talked about tonight. You're hitting everything that I'm telling you in terms of like the bottom of the bear market that is going to set us up for, you know, for several years of, you know, of an uptrend. And the markets can discount everything that the Fed is talking about. The news is going to be horrible, inflation, yada, 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 but the market's going to be discounting it. The markets can discount the recession. It's going to discount inflation. Yeah.
I have a question. My sister told me that next week, announcement's supposed to come out to let everyone know that we're in a recession. And I'm like, why is an announcement coming out next week?
It's not. I don't know. I mean, it could be. I mean, certainly the government's not. The Bureau of Labor Statistics announces when we're in an official recession, and you have to have 2 consecutive quarters of negative GDP. The quarter's not over yet, so I mean, you're going to have economists like mentioned earlier. Daniel DiMartino Booth says we're in a recession right now, and but she's a third party economist. A number of people are. You can find anybody out there that will justify what your view is.
Yeah, I mean, as a consumer, I feel like we're in a recession. It's just me.
Yeah.
I mean, it's crazy out there right now, I feel.
Yeah, I mean, I've got I've got a number of very affluent friends, and I had a buddy of mine that his kids are in town for the week, and they were going to go out to eat. They've already gone out to eat at a restaurant twice, and he spent $500 both times.
Yep.
And the last time, and they wanted to go out again, and he nixed it because he didn't want to go to a restaurant at 5:30 and pay $500 and be out of there in an hour. So even the people that are really affluent, I mean, they're going to pull in their, they're going to pull in their, their consuming habits.
I'll tell you what, me and my wife love to go out to eat, but lately, I mean, it costs just me and her $60-$70, even if we just want to go to Buffalo Wild Wings. So I told her, you know what, we're ordering Domino's. We're paying $10 for a pizza. We'll stay home.
Yeah,
it's crazy.
I like a good steak every now and then. And I was looking at Harris Theater the other day, and 2 ribeyes were like $57.
Yeah.
And I said, I think I'll eat chicken. I mean, $57 just for me. And, that's like, it's not necessarily affordability either. It's just like, man, it's just, it's just the idea you're getting.
Now imagine someone that has 4 kids or like, a family to feed. That's where it really is.
Yeah.
Roy, what's going on with the acquisition with Apple, with Square? Did Square turn them down? What happened?
I'm not aware of that. I haven't heard anything about an acquisition.
Okay.
Stage 4 downtrend. I mean, where's the bottom? There's the broke the 10-month, then it hit the 50-month. See, that's what you have to be careful of here. Given, there's no way of suggesting that, where the bottom is on these things that rolled. There's Teledot, broke the 10-month, went to the 50. Look, then it got cut. Went down 70% after hitting the 50-month.
Hey, Roy, I don't know if you probably run this every day, but the guys at Trader Lion really hammered in my head to do this every day is, each day after the market close, I just filtered the US common stocks. I run a liquidity scan, 7 million shares or more. I filter it by the industry group, and I just click through all the names just to see if there's any bid or theme or something, arising in the market. So I just want to share that with everyone. If you guys do that on a daily basis, you guys can, see if the market has a bid or, there's a theme emerging in a certain sector or anything like that.
Thank you. That's great advice. Yeah, and you can always look to, this is the whole database, what's down, what's showing up. You can clearly see a lot of that stuff. Guys, I think I'm gonna call it a night. It's 10:57. I want to again thank you for attending. I hope that you acquired some help and knowledge and information that might help you navigate through the markets as we all get through this together. And I'll put you on the there were a number of people that wanted to get on the email list for the first time. I'll do that. We'll probably send out a summary of the call tonight. Probably do that tomorrow night or the next couple of days once the Fed meets. So again, thanks for attending tonight, and happy trading.
Thanks, Roy. Have a good night.
You too, guys.
Thanks a lot. This was great.
Okay, guys, take care.
All right.
Thank you.
You're welcome.
Thank you, Roy.
You're welcome.